Welcome, everyone, to the European Market Open. A minute to go until the start of cash equity trading. I'm Francine Lacqua here in London with Tom McKenzie.
Here are your top stories. Inflation jitters. Chinese data highlights the pressures building in the global economy. US CPI data is due out today. Joe Biden backs away from the immediate release of oil reserves. WTI and Brent extend gains. And the Super Return Conference gets underway. This hour, we speak to Carlyle co-founder David Rubenstein. If you have any questions for our guests, IB plus TV Go.
Now, Tom, let's also look at the futures. It is Wednesday. It's topple day. For those of you that had a rough Monday and Tuesday, Wednesday should be looking a little bit better. We did see pressures on futures. Now we're seeing gains pretty much unchanged because the focus is really on CPI data. Out of the U.S., we had some factory gates orders in China that was actually disappointing because they worried the market that suddenly we had inflation that's maybe a little bit less transitory than we thought.
Yeah, these higher prices for China's factory gates, they do enable them to pay down the debt load, but of course, you're seeing now it bleed into the CPI, just marginally at least, and of course, it could constrain the PBOC's ability to pump additional liquidity into the system to support a recovery that we know is starting to falter in China. So that is an area of focus for us. In terms of what's happening here in Europe, in the first few seconds of the trading day, the Spanish IBEX is flat. The UK Ftse 100 is flat as well. Bear in mind, of course, that basic resources and those commodity prices have come off, particularly iron ore, on the concerns about the property sector in China. Evergrande in front and center again today with the end of this grace period for 2 bond payments. We are watching that. In terms of how things are playing out on a sector-by-sector basis, we can switch up the board and see how this is flowing through then. We are looking, of course, ahead to those CPI numbers out of the US later today. You could be looking at the highest print in terms of consumer prices out of the United States since 1990. The US 10-year is currently at 147 Brent. We talked about the fact that oil is in focus. Biden has pulled back from releasing these strategic reserves, at least for now. So you're seeing some upside for oil, up 0.5%. Iron ore, again, linked to the China story, under pressure, down almost 3.5%. Bitcoin, cryptocurrencies, still of interest, of course. You've seen some pressure on Coinbase over activities. And then, of course, the question marks about whether or not you can get back to that record high that we saw earlier in the week. Currently at 66,000, down almost 2%. Fran.
Now, Tom, let's also dig deeper into some of the sectors. Now, there's a couple of things that we're watching. It's been about everything about energy and oil. We had an IEA report and an EIA report. So one is the American Department, of course, of Energy. The other one is the international agencies. And we heard from the U.S. they're actually expecting, again, these prices to come down. So they're not releasing any strategic reserves, which is why we're seeing energy amongst some of the biggest stocks on the move. So energy, for example, I think it's right behind me. And you can see it's now in the green, gaining some 0.8%. Overall. Banks also gaining some 0.8%. And some of the biggest movers is, for example, on the consumer side of things, although we do have, Tom, a big M&A. I know you have some of the movers. I'm sure we'll talk about DoorDash a little bit later because it bought an $8 billion company. Look, if you look at the overall S&P, so it's gaining some 0.1%. We're seeing things that are gaining and losing, but actually not by much because that range is, either 0.4% lower or 0.5% higher in terms of the sectors.
Yeah, in terms of some of the individual stocks that we are watching, Allianz, of course, the insurance provider, but also wealth management. And this was a key part of the business that came good for them in the latest set of results. You can see gaining at 0.7%. It was a beat for Allianz on a number of the key metrics. Credit Agricole also did better than expected. Loan loss provisions came down. The earnings of the trading unit were down by about 20%, but they were more than offset by what we're seeing, or at least partly offset by what we're seeing in the corporate side of the banking unit. So Credit Agricole overall was a beat, gaining 0.4%. Infineon, this is interesting around the margins story. They're raising their outlook for margins, not just for the first quarter, but longer term, 2022, they see a strong fiscal year for next year. Margins key to this semiconductor producer, and so far they are doing on the back of this up almost 3%, that stock, just in the first few minutes of trading day here. Okay, let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. General Electric will split into 3 separate companies in a stunning breakup of the conglomerate founded by Thomas Edison, once the world's most valuable company. GE will spin off its healthcare arm by 2023 and combine its 3 energy businesses into another separate entity. GE Aviation, its jet engine unit, will make up the 3rd company. EV maker Rivian will price its shares at $78 each after expanding its IPO. That's above the top of its marketed range and will raise almost $12 billion, making it one of the biggest listings of the year. Rivian is backed by Amazon and Ford and delivered its first vehicles a couple of months ago, mostly to its own employees. The CEO will be giving his first interview of the day to Bloomberg later. DoorDash is buying Finnish food delivery company Wolt in an all-stock deal valued at around 7 billion euros, its biggest purchase to date. DoorDash says the takeover will speed product development and improve value to customers, merchants, and couriers around the world. Tom, Francine, who says Wednesday's too early for a takeaway?
I mean, I don't have a rule. I feel like, there's no dry January. When it's tough, so you should have takeaway on Monday and Tuesday. And then on Friday, you can cook so you have time. It's a weekend. You should do everything in reverse Tom.
No dry January in
no dry. I mean, it's the worst
Lacqua
month.
household.
No,
you want to be drinking through January because it's a miserable month, isn't it?
Yes.
Power through. You can stop drinking in the summer.
Finally,
surely.
Tom McKenzie understands the Lacqua values. Now, for more on the markets, let's bring in Bloomberg's Christine Aquino. Christine, I don't know whether we talk about DoorDash and takeaway and alcohol consumption in January, but certainly when you look at the markets, they're very much focused on oil inflation.
Absolutely, Francine. I mean, this is part and parcel of the big story of rising costs for consumers, right? And oil is definitely part of that equation. I mean, I suppose it's a good thing. Markets are taking it as good news, right? That the U.S. Backed away from tapping into their oil reserves. But I think the net effect of that is just even higher energy prices at a time when consumers are already struggling with their household costs.
In terms of the inflationary story, we've seen, of course, what's happened out to China with those producer prices, CPI coming in marginally above the estimates as well. The concern broadly is that inflation is becoming more entrenched. CPI today, what are we looking at out of the US?
Well, Tom, I mean, obviously we're looking for that core number as well as the headline number, right? Because I think that will really tell investors how entrenched prices are getting and whether that transitory argument that central banks are still putting forward still holds water. I mean, consumers, banks, we've heard warnings that it is looking more than transitory. And I think any evidence, particularly from the core number today out of the U.S., will help build that case.
The thing is, Christine, is that these inflationary pressures are there. They keep on rising. But if you believe that they're gone in 6-7 months, then you say, well, it's transitory. And so I don't know when there's, the crunch point where you actually realize whether it's transitory or not. Is this like 3 months out? Is it, like what kind of time frame are we looking at?
Well, I think that's the big question, right, Francine? Because, I mean, even if it's for, say, for example, 3 to 6 months out, that's still 3 to 6 months of households really getting pressured by these soaring costs, right? And I think markets are trying to discern that by looking at things like real yields, for instance. I know that investors are really trying to read the signals out of that and seeing what does this all really mean, Does this mean that there is a very pessimistic view on the economy over the next 6 months or so? Or is this really more function of inflation really getting out of hand in the short term, but then eventually or falling back down? And so, yeah, I think like that's one particular signal. It usually tends to be the canary in the coal mine that investors are watching for. Lots of discussions over what real yields mean at the moment, and so we'll be watching that as well.
Okay. Christine Aquino, thank you very much for your take, of course, on what to look at in terms of the inflation story and the oil complex as well. So far, the Biden administration holding off on tapping those strategic reserves. Just a line crossing, and it's a redhead, the terminal right now. M&S, Marks & Spencer, shares rising 20%. That's after they lifted their full-year forecast. So they're seeing strong demand, not just for food, but also the clothing side of the business, Francine.
Yeah, interesting, because I was in an M&S just a couple of days ago. I'm no retail analyst, but I do shop around, and actually it was a beautiful collection, so that probably helps. We talk a lot about these share prices kind of philosophically, but if you go into a store and you like something, the chances are that a lot of people will like it as well. It's quite amazing looking at the expectations forecast, because M&S has had a really tough time of it.
Yeah, it's had a tough time. I mean, you talked about the collection there, and years gone past, the last few years, people will go in and say, there's a drab collection here in terms of the clothing. They've been trying to turn that around. It seems like now they're having some success.
Yeah, frumpy no longer. M&S also saying that cost pressures will actually become progressively steeper, so we'll have a look at what that means for margins. Now, coming up, under pressure. Yeah, Biden meeting with business executives as supply chain issues threaten the holiday season. We discuss that next. This is Bloomberg. The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world, There are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open, everyone. 11 minutes into the European trading day, and actually, we're seeing gains. Now, it's not huge gains, nothing to write home about, my favorite British expression. But if you look at some of the support level, look, overall, the stocks in Europe are gaining some 0.2%. Before they were lower because we were concerned about inflation. In China, now the factory gate orders actually really were the highest in 29 years in China.
26 years, yeah, but very high. That's the point. Yeah.
Very high, and so it's difficult. I mean, I guess $1 million question is that do they come down from this, or actually will they stay higher for longer?
Yeah, I think also a key question is, so to what extent does it bleed into CPI? We did see CPI going up to about 1.5%, so slightly above the estimates. It's still relatively in a zone of comfort for the PBOC, but does it constrain them in terms of, there's so many economists who come out and said, the PBOC, the Central Bank of China, will come and support this economy with a triple R cut, a reserve ratio cut, by the end of this year. Now, people are starting to walk back that assumption, given that prices are so high now. So what does that mean for support of an economy where the rest of the data is looking very fragile in terms of that recovery?
Yeah, and again, I think we have to remind ourselves, especially if we're investors based in Europe or the US, is that they have still a zero COVID policy, which means that supply chains are affected a lot. And actually, you could see, for example, a port stop because of rising cases. Now, today, we've had a lot of companies reporting, and that's given us an update on this global supply chain crunch, which is so crucial to inflation. For more, we're joined by Bloomberg's Lizzie Burton. Lizzie, great to have you on air today. So how's Adidas going? They had results. What did they tell us?
Yeah, Adidas has had a 600 million euro hit from these Asia supply issues, and the situation is especially dire in Vietnam. We know Vietnam's had this resurgence in COVID cases, which has led to factory shutdowns and worker shortages. And just this morning, a key supplier to Adidas has said that 6% of its workers have quit, which means it's going to struggle to meet orders. But it's interesting to compare the impact on Nike and Puma. Nike's also had to lower its sales forecast, but Puma's pivoted to China, so it raised its forecast. But all three are going to be hoping that the Biden administration saves the day and ramps up vaccine donations to Vietnam.
In terms of what's happening with Infineon, it's a different picture on the question of margins, and they've actually raised their forecast for the first quarter. What's happening with that semiconductor maker then?
They have. They said that revenue grew more than expected. The CEO said that he was confident that this higher demand for semiconductors would last. So Infineon's investing to take advantage of that. It's leaning in to the aftermath of this supply crisis, the global chip shortage.
Okay, Bloomberg's Lizzie Burden there on the differentiation we're seeing between Adidas and Infineon when it comes to the questions of margins and which companies can absorb those costs. Pricing power has been central for the analysts that we've been talking about. Let's check in then on some of the other stock movers that we are looking at. And by the way, we're going to be speaking to the CFO of Continental later in the show, Wolfgang Schäfer, as well. Also, supply chains, input prices will be central to that. The German company reporting third quarter earnings. That interview just just after 8:30 London time. Okay, let's check in on those movers very briefly. We've got Allianz, Crédit Agricole, and Infineon. It was beats across the board for all three of these companies. We're going to be looking at M&S as well shortly, but let's take you through what's happening with Allianz then. The wealth management part of the business is doing well. The stock, by the way, down 0.4%. Nonetheless, it was a beat in terms of third quarter operating profits, 3.24 billion above the estimates. Crédit Agricole, loan loss provisions coming down. You're seeing a loss in terms of the share prices, down 1.5%. Third quarter profit, by the way, jumping at the French lender by 44%, and again, beating estimates. Nonetheless, you're seeing pressure on the shares just in the first 15 minutes or so of the trading session here. Infineon, as Lizzie was mentioning, they have done well in terms of those margins, and they have raised the forecast for those margins for the first quarter, also saying that they see a strong fiscal 2022. You're seeing gains there of more than 2% for the semiconductor maker, Francine.
Yeah, I mean, there's quite a lot going on. Again, it ties back to inflation, all of the supply chain concerns. Now, this is what we're looking at across the board. Meanwhile, President Biden has met with top U.S. executives on the supply chain crunch. That's as pressure has been piling on the president to clear supply chain logjams and ease inflationary pressures as consumers begin their holiday shopping. Well, joining us now is Chris Dyer, Director of Global Equity at Eaton Vance. Chris, thank you for joining us. I have 1,000,001 questions, and I'm not sure where to start, because if you look at equities, it's margin pressure, and they also want to know what happens to inflation. When do we find out, when are we settled on whether this is transitory, even if it rises?
Yeah, I think we're not going to have that question this year. It'll stretch into next year. We're seeing inflation across every sector across the globe, as we're hearing today in China. And I think the question there is, with regard to natural resources, inflation on that front, logistics costs. We think that's more transitory in nature and likely to subside a little bit as we enter and go through 2022. Wage inflation, on the other hand, I think is something that is more likely to be sticky because once wages rise, there's a shortage of employees. It's difficult to see that coming off.
Chris, how does that inform then the way that you differentiate across sectors? Do you look at companies that are reliant on large labour forces and workforces and cut those out of your portfolio at this point? How are you thinking about the stickiness of prices and which companies have that pricing power going forward?
I think the key thing that we look for is the quality of the business model and the ability of the company to put through price rises due to differentiation of their services or products. And so if you look just within consumer staples, it's generally considered to be a very stable market. But if you look within that, we're seeing a lot of different impacts from inflation. So within the food and beverage sector, much less inflation, and the companies are able to exercise their pricing power, and margin pressure is not quite as significant there. If you look at Coca-Cola, they actually reported an increase in gross margin in the quarter. So they're able to offset the inflation. On the other hand, you have home and personal care. Inflation there is going much higher. I'm sorry?
And you like Europe as well.
Absolutely.
Is this on valuations?
Very much so. Europe is trading at a very big discount to the U.S. We think that there is going to be a period of multi-year outperformance of Europe driven by some of the valuation. The tech leadership in the U.S. market has been persistent for so long, but it's very narrow. If you look at the U.S. market, the S&P 500 is at all-time highs, but within that, only about 16% of companies are at their 52-week highs. And so what that indicates to us is that there is an opportunity for stock picking, both in the U.S. as well as in Europe.
Okay. Yeah, stock picking, that is the time, that is the case you want to make. And also, interestingly, and that would be the argument as well from active managers, is that as central banks to pull back their support and that blanketing of the markets is removed, then it becomes more of an opportune moment for that stock picking. Where are you being drawn? What are some of the companies that you can flag for us, Chris, where you see real opportunity at this point?
Yeah, I think there's a few. If you look within the consumer, the building materials space, CRH, which is an Irish company, but half of their profits come from the U.S. market. They are the largest road builder in the U.S., and so the infrastructure bill that's just been passed in the U.S. market is going to be a tailwind of them over the next 5 years as highway spending increases by roughly 50% over that time horizon. So that's a great opportunity. Kingspan is another Irish company, but they're seeing a long-term secular driver in terms of the efficiency, the energy efficiency of the insulation that they produce in their panels and boards. And so we see a long runway of growth driven by regulation across the globe for that space.
Chris, I wanted to ask you actually your craziest pick or something that's off the beaten track, but I might ask about cryptocurrency. Is there an equity that gives you exposure to cryptocurrency without actually buying them?
We do not have direct exposure to that
because
at this
it's just
point.
too...
It's a little bit too difficult to predict. What we like to invest in are companies that we have a very good understanding of what they're going to look like in 5 to 10 years. And
Well, you actually like fundamentals, Chris.
Fundamentals, yes, absolutely.
Shock horror. Healthcare. We've had some developments in terms of treatments when it comes to COVID. Very positive developments with these pills that may be available possibly next year. How does that kind of change your view of the healthcare sector?
I think healthcare is a very interesting sector as an investor because it's largely insulated from a lot of the cost inflation pressures that we've been talking about. It's also insulated from a lot of the macro pressures and uncertainty. And so you look back yesterday, I think it was 1 year since the Pfizer vaccine test results came out. And then early, I guess a few days ago, we just had the antiviral announcement. And so a lot is happening within healthcare that has ramifications more broadly across society. But within healthcare, a company that we really like is Novo Nordisk. It's known for its diabetes franchise, which has been a long-term driver of growth for them. But they've recently introduced an anti-obesity drug, which is really a huge breakthrough for them. And if you look at estimates, obesity is predicted to affect about 1 billion people across the globe by 2025, and so there's a significant opportunity there to be addressed.
So you don't like any of the bigger companies? I mean, it's interesting when you look at your stock picks that you mentioned. There's also, I think, Kingspan as well. There's CRH, which is this huge Irish construction company. Is there anything that's kind in the consumer staples? I don't know whether it's a luxury play or something like that that you'd potentially be interested in.
Yeah, we think luxury is a great spot. Just those are companies that demonstrate brand power and pricing power.
Yeah.
But we're increasingly a little bit concerned about the Chinese consumer.
Okay.
And that has been a big driver of their growth, both domestically and through international travel. And so we're a little bit more cautious on luxury than we have been in the past.
Chris, thank you so much for joining us today. Chris Dyer, there, Director of Global Equity at Eaton Vance. Now, coming up, Tesla loses nearly $200 billion in market value in its biggest back-to-back sell-off in 14 months. We have that story next, and this is Bloomberg.
Okay, welcome back to the Open. We are 24 minutes into the European trading day. You're seeing gains of 0.2% across the European benchmark stocks 600. Okay, let's get to a major corporate story then. Tesla, which has lost some $200 billion in market value in its biggest back-to-back sell-off in 14 months. Joining us now is Bloomberg's Stefan Nicola. Stefan, thank you for jumping on the line for us. What's caused then, what is behind the Tesla sell-off of the past few days after such a significant hot run-up for this company?
Yeah, so basically it's a trifecta of things. And it really started on the weekend when Elon Musk asked his Twitter followers whether he should sell 10% of his stake in the company. And they said, yeah, he should. And then that was followed by news that his brother Kimball sold shares just before that poll. Capping it all off was an insider report Tuesday morning that Michael Burry, the investor made famous by the movie The Big Short, said Musk may want to sell shares to cover his personal debts. So all of that combined and probably some healthy profit-taking led to this rout.
I mean, sometimes you wonder if it's more volatile than crypto, Stefan. What impact has this had on Musk's personal wealth?
Yeah, well, so Elon Musk has lost about $50 billion so far this week. But, you know, after all, we shouldn't feel too bad for him. He still is the richest person in the world, and his fortune still is up about 70% this year, thanks in part to Tesla's massive gains, but also, you know, a higher valuation for SpaceX. So, you know, don't feel too bad for him.
Yeah, we're not weeping quite yet. Stefan Nicola, thank you very much indeed on this Tesla sell-off, the impact on Elon Musk's wealth. Okay, coming up, Carlyle's David Rubenstein talks to Bloomberg ahead of his keynote speech at Super Return. We are live in Berlin with that interview. European stocks, Europe 600 up 0.2%. The Ftse 100 up 0.3. Over in Italy, gains of 0.5%. This is Bloomberg.
Проходим опасный участок, ответственный. Устам поднимает тебя на жимаре. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца как бы внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. This is what we're looking at. So inflation jitters, Chinese data highlights the pressures building in the global economy. U.S. CPI data is due out today. Joe Biden backs away from the immediate release of oil reserves. WTI and Brent extend gains, and the Super Return Conference gets underway. Up next, we speak to Carlyle co-founder David Rubenstein. If you have any questions for any of our guests, IB Plus TV Go, or you can tweet us as well. Tom, looking at the markets.
Yes, it's
inflation.
It's a modest midweek bump for the European Stock 600 so far. That. 30 minutes into the trading session. Inflation,
modest midweek.
The modest midweek bump of 0.2% so far. 30 minutes in. You're absolutely right. Inflation, of course, front and center. Given what we saw in China, those PPI prices, the factory gate prices at a 26-year high, and the focus now shifting to consumer prices out of the United States. That could be the highest since the 1990s. What does that mean for the rate hike cycle? Because markets are now pricing. This is the view for markets. They're starting to price the fact that by early 2023, that could be peak rate hike cycle. That is the market view at this moment. Will that change on the back of this CPI data? 0.2% is the gain that you're seeing across the benchmark here in Europe. It's flat on the DAX, gains of 0.2, gains of 0.1% over in the CAC 40, over in France, and stronger picture here in the UK, gains of 26 points or 0.4%. Part of that is down to what you're seeing in energy prices. Brent is up, WTI is up. Biden is not yet ready to tap into those strategic reserves. Let's break it down, see how things are playing out sector by sector then. On the flip side, by the way, of the energy and input price complex, you've got iron ore that is lower on the concerns in China around property, and we do have those grace periods for 2 bonds for Evergrande coming to a close later today. We are watching that. Energy is gaining 1%. Retail is also up 0.7. At the bottom of the screen, you're seeing losses for consumer and travel. Consumer down 0.7%. Now, that's a shape of play about 32 minutes into the trading session here in Europe. Fran.
I like that. 32 minutes and 0.8 seconds. We like to be precise. Tom McKenzie, very precise with that wonderful market action. Prior to founding one of the world's largest private equity firms, the Carlyle Group, David Rubenstein was a successful lawyer who was an advisor to President Carter. He now sits on the board of numerous top institutions, including the Smithsonian and the Council on Foreign Relations. He's also found the time to publish 2 books and host his very own TV show, which of course airs here on Bloomberg TV. While our very own Danny Berger is sitting down with him ahead of the appearance at the Super Return International Summit in Berlin. Hi, Danny, over to you.
Hi, Francine. Thanks so much. I'm really pleased to be here with David Rubenstein, of course, as you said, co-founder of Carlyle and host of the David Rubenstein Show, peer-to-peer conversations. David, first off, thanks so much for sitting down. I know you have a very busy day ahead of you. So you're giving the keynote speech tonight. I don't want you to front run it. It's, of course, called the 10 Most Important Geopolitical and Economic Questions Facing the World. But can you give us a little taste for the people here at this conference, the titans of the investing world? What's the #1 question they need to be asking themselves?
Well, right now, when you think about it, this conference was held 2 years ago. If you had known 2 years ago that we're going to go through COVID-19 as bad as it was and went through an economic recession as bad as it was, you would have thought that the private equity world would have gone down. Actually, private equity world is healthier than it's ever been. So my point today is going to be that if you look at the most important economic and geopolitical issues facing the world now, is it likely that we can also ignore them over the next 2 or 3 years and just have the private equity world be in a bubble of its own? My concern is that maybe we can't. So I'm trying to get people to pay attention to what the big economic issues are and geopolitical issues, because they're probably going to affect the private equity world over the next couple of years. I'm not sure we can escape being affected by them the way we have been really over the last year and a half.
So what are those issues that you think we won't be able to escape?
Well, the #1 economic issue is when interest rates go up, as they inevitably will asset prices come down, and will it be more difficult to sustain all the values that people have had over the last year and a half? I'd say the biggest geopolitical issue is the U.S.-China relationship. It's obviously not as pleasant as we thought it would be after Biden was elected. In fact, it's probably no better than it was under President Trump, maybe even worse in some cases. So as a result, I think people have to worry about investing in China or doing business with China. That's an issue. And also, what are the ramifications if the relationship gets worse? For example, suppose there's something happens with Taiwan, how is that going to affect the chip business, for example, so much of which is produced in Taiwan? So those are the two big issues, I think, geopolitical, U.S.-China, and economic. Interest rates, when they do go up and the bond buying stops, what's the impact on private equity and the stock market?
Let's dig into China a bit, because I know last year when you spoke to us, you talked about the U.S. being the best place to invest, but China wasn't too far behind on your list. Given the changes which you laid out, which have happened over the past year, which have accelerated, is China still an attractive place to be investing?
China is attractive, but it's not as attractive as it once was, I think, in part because the regulatory environment there has gotten to be much more complicated. More American companies are afraid of doing business there, and China has obviously made some steps to kind of thwart some of the efforts of some of the Chinese business leaders to be more visible. As a result, it's not quite as welcoming as it seemed to be 2 years ago. But China does still have 1.4 billion people, gigantic consumer base, and it can do very, very well for people that invest there. But you have to really know what you're doing, have people on the ground, and be very careful.
Yeah, this is something that we hear all the time, that you kind of can't ignore China, right? It's so huge. But considering some of the geopolitical tensions as well, how in general should we really view China and their place in the global community?
Well, China was the biggest economy in the world for most of organized history. And then in the 1700s, Europe came along and the United States ultimately came along. China thinks it's regaining its rightful position. And think about this. China was roughly 1% of the world's GDP when Richard Nixon went there. Now it's roughly 17% of the world's GDP. So it's grown dramatically and probably going to continue to grow at the pace that it's been growing. The United States is not going to grow at the pace that China is growing. So at some point in your lifetime, in my lifetime, China will be the biggest economy in the world as measured by GDP. As measured by purchase price parity, it already is the biggest economy in the world.
Well, let's bring it a little bit closer to your home and Carlisle's home in Washington, D.C. The House on Friday passing the infrastructure bill. How important is this, that this gets to fruition, that this is finally put into action in order to have the U.S. be competitive with places like China?
It's a very good bill that have been passed, but I want to make sure everybody recognizes what it is. It's a 5-year bill, more or less. And over 5 years, above what we'd otherwise would appropriate, it's basically $100 billion a year, which is not nothing, but it's not going to dramatically change things overnight, and it's over a 5-year period of time. So it's very important that it passed. It shows the president has the leadership ability to get something through Congress. Now the trick is, can he get the soft infrastructure bill through, which is much more politically difficult.
Right, and part of that difficulty also has been taxes. Some of the proposals, higher corporate tax, the cap on salt, lifting that as well. How do you see that discussion evolving? Is it going in the right direction?
I don't think that they can pass the soft infrastructure bill or the Build Back Better bill with taxes increases in there. I think it's very unlikely you'll have anything or except marginal tax increases. I just don't see that being able to get the support in the Senate. So because Senator Sinema and Senator Manchin are not really in favor of these big tax increases, I suspect it'll have to be paid for in other ways.
And so what are those ways that you can pay for it and still have a constructive business environment?
Well, what people like to do when they want to pay for something in Washington but don't want to raise taxes is they say we'll have higher economic growth. So you'll probably get projections of higher economic growth,
right?
Maybe some greater IRS enforcement, and then trying to find money in places that it was not spent before. So, for example, COVID has some money that was not spent. They'll take some of the COVID money and apply to this. So there are some games that people play. And remember, one of the things you're talking about with these kind of bills is this is 10-year spending. And one of the easiest things in the world to do is to say, we're going to spend money in the years 1, 2, and 3. We'll make it up by getting taxes back in years 8, 9, and 10. But that never shows up. That never actually happens. So the 10-year budgeting system we have allows us to get very big deficits and big debt. When the Budget Act of '74 was passed, the debt of the United States was under $1 trillion. Now, since we've had this Budget Act, the debt is now roughly $29 trillion. Right. So the system we have isn't really working to keep the debt and deficit low.
Right. You mentioned the hope and often the political hope for economic growth. David, we have just about a minute left, but are you confident about the growth trajectory of the U.S.?
I think we have a pretty good situation coming out of the recession, or not the recession we had before. I'd say the COVID situation was helped by the enormous spending by the Congress and the Fed's easing up of interest rates and bond buying. As we get out of that program, I suspect you'll see some asset prices go down a bit. I think the U.S. economy is in reasonably good shape. and I don't worry about a recession in the near term.
All right, it's a great optimistic note to leave it on. David, thank you so much for joining us. That's David Rubenstein, of course, co-founder and chair of Carlyle and the host of the David Rubenstein Show, peer-to-peer conversations. Francine, Tom?
Great stuff, Danny. Thank you very much indeed. Okay, and just a reminder for our viewers, David Rubenstein is the host of the David Rubenstein Show, of course, peer-to-peer conversations, which airs on Bloomberg Television. Fran, we have some movers.
We do have movers. Actually, M&S, look at that, it's flying off the shelves. You see what I did there? M&S, so this is, if you're an international viewer, this is a big company here in the UK. Of course, that does close. Previously considered as a little bit frumpy. Now they seem to be doing pretty well. It's raised its profit forecast. They also do supermarkets. They raised their profit forecast for the second time this year. They're looking at strong food sales and a recovering clothing demand. And it does suggest that the British retail chain long-awaited turnaround is finally taking effect.
Yeah, the restructuring of M&S. I remember when it had international branches in France, even in Beijing. Adidas, that is falling under pressure. You can see by 6%, look at that, on the back of supply chain constraints. Vietnam, where they produce a lot of their items, of course, but also a boycott in China over cotton and concerns about Xinjiang. So that is pressuring that company as well, under pressure by about 6% currently in the session, Adidas.
And this is another gainer, actually, for me. ITV, we give you the losers, me the gainers. ITV gaining some 8.6%. It jumped after the broadcaster said it expects full-year advertising revenue to be actually the highest in its history as the economy here in the UK, but also abroad, is rebounding from lockdowns. And it does bring back brands saying, look, I want to go into TV channels to make sure that people know that I'm back, and I mean business. Now, coming up, Continental reports a big drop in earnings for the third quarter as a chip shortage hits global car production. We speak to the company's CFO, Wolfgang Schäfer, next. This is Bloomberg.
Do you enjoy being a senator with all this pressure on you? Is this fun, or is it not that much fun?
My dad always said, if you can say no with a tear in your eye, you might be okay. And I've been crying a lot lately.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. 44 minutes into the European trading day, you're seeing gains across the stocks 600 of about 0.1%, just pairing some of the earlier strength that we saw just 5-10 minutes ago or so. In terms of what we're seeing here in the UK, gains of 0.4%, different picture over in France, where you are essentially flat as you are in Germany as well. Switching focus now to the corporates, because we've had another big day of earnings. Continental has reported a 42% drop in adjusted EBIT for the third quarter. Europe's second largest car parts supplier says the drag from the chip shortage and higher prices for raw materials is growing significantly. Joining us now is the CFO, Wolfgang Schäfer. Sir, thank you for joining us this morning. The drag then from the input costs and the supply chain constraints around semiconductors. Give us the time frame for how long you expect this to persist and the measures that you and the team are putting in place to mitigate some of these impacts.
Well, these are two different topics which we are talking about. The one thing is the raw material price inflation, which we see, and specifically in our rubber group, we had only this quarter 300 million more in input costs than we have had it in the year before. And the good news is, nevertheless, we have managed double-digit earnings in this division. And the other good thing is, in this group as well, the trend towards the bigger rim tires, positive for us, is continuing. So there are good elements in it. But you're right, specifically the semiconductor shortage, which we are feeling at the moment, is heavy weighting on the sales level of automotive, and as well adding to extra cost, extra freight costs, chip costs are increasing and everything. How long is this going to last? Difficult to predict. We expect that capacity increases from our suppliers will be there in significant ways only starting in the second half of next year, and even this is not completely guaranteed. We are working on many issues to get better there, to improve our deliveries, and to make sure as well that long term we will not be hit from such a shortage as we are at the moment.
So, Mr. Schäfer, at this point, what is actually your biggest concern? Is it energy? Is it chips? Is there something else? And actually, do you worry that this will lead to some of your, peers facing legal challenges because the delivery times are just not met?
Well, the major concern at the moment where we are working most on is this semiconductor shortage, which we see all over the industries, not only automotive industry, but hitting us as well. And yes, besides having more than 700 people at Conti only working on getting as much chips in time to our customers as possible, we are working as well on a more long-term perspective, lessons learned, how to, as an industry, not only as Conti, but as an industry, how to improve and be more safe against such threats than we are at the moment in the future.
When it comes to the margins, because of course input price is crucial to what you're seeing there, and you're guiding 5.2% to 5.6%, so quite a ways away from the medium-term goal of 8 to 11% for the margins. When do you think you get back there? What is the time frame? Have margins started to bottom?
Well, you think the good news of all this, what we were just discussing, the good news is as supply is increasing, we don't have any problem with demand. We see that then our sales should really go up and should really increase, and this would be a big step towards our target margin of the 8 to 11%.
What is the one thing, Mr. Schäfer, that actually you think we should have foreseen? I don't know whether it's energy prices. It's pretty incredible that, some of these supply shocks no one had foreseen, not the economists, not some of the chief executives. Are we going to have a better reading on some of the raw material shortages and some of the energy prices in the future? Are we looking and measuring things wrong?
At least we are working on these topics to make sure that our demand forecasts are even getting better. Translate this into supply chain topics, which we want to get better than we have been in this situation. Again, not only as an automotive industry, but this is true for many industries. I think many, and I know many are working on this, to be more resilient against these type of situations, which is unique, very different than what we have seen in the last financial crisis, 2009, 2010. To get better, to get more resilient, and to get better through situations like that than we have done it in the past. To find the complete remedy against raw material price increases, I think this is not possible. In the end, the business always has to be strong enough to react on it and to make sure that those costs which are hitting the business can be passed over to the consumer. And again, I mentioned already our tire and quantitative business, where the margin is still double-digit, though we had a big hit in raw material price increases as well.
Okay, just very quickly, any more spin-offs for the business, or indeed acquisitions amid this transition to EVs?
I don't expect any spin-off in the size of the powertrain business or any other spin-off in the next months to come, and to be a big news for Continental.
Mr. Schaefer, thank you so much for joining us. As always, the Continental Chief Financial Officer there, Wolfgang Schaefer, and we do hope one day, very soon, to actually see you face-to-face in our London studio. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. France's Emmanuel Macron has sought to rally the nation, presenting a bright outlook for the economy in a national address. The president warned older people they must get a booster shot or see their so-called health pass deactivated, stopping them from going to cafes or restaurants. U.S. Vice President Kamala Harris, meanwhile, is embarking on 5 days of diplomacy in the country as she looks to heal a rift between the U.S. and its oldest ally. She'll meet with the French president at the Élysée Palace today. Health Secretary Sajid Javid has told frontline National Health Service staff in England they must be fully vaccinated against COVID-19 by April of next year. Over 100,000 NHS workers are not yet double jabbed. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Okay, Laura, thank you. Coming up, the beginning of the end of COP26. With a draft of the summit communique now released, we will discuss what it means for the future of our climate. This is Bloomberg.
Its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 50 minutes into European trading day, and actually you can see a lot of the stocks and the movers are kind of trading sideways. First they were concerned about inflation, then they took in their stride and actually looked at some earnings that really beat estimates in terms of forecasts, for example, advertising spending and ITV, and now they're kind of trading sideways, looking onto US data, CPI, later today. Now, this morning, the UK presidency of the COP26 released a draft text of the summit communique. The text will now go to consultations with national capitals as a meeting in Glasgow enters its final phase. Well, joining us now live from Glasgow is our COP editor, Emma Ross-Thomas, who's been, of course, leading and fronting our coverage. Emma, first of all, what should we make of this? Will COP be remembered for some of the pledges and the communique, or for the protests?
Yeah, that's an interesting question, isn't it? I think, the protests were certainly spectacular, but now we get down to the nitty gritty, and those documents dropped this morning at about 6 o'clock. I suppose the first thing to mention is that we had been promised them around midnight, and in the end they didn't emerge until somewhere around the 6 o'clock hour. So that gives you some indication, I think, of the degree of haggling that's going on. So there's something for everyone. On the one hand, the language on temperatures, the Paris Agreement talks about keeping global warming well below 2 with a sort of efforts towards 1.5. The UK has been talking about keeping 1.5 alive. Of course, this is important because the fallout of 1.5 is very different to 2 degrees. So the language is pretty much the same as what we got from the G20, so not much to write home about there. But what we do have is there's been a push from both the climate vulnerable countries and the UK and the US too, actually, to get countries to rewrite their climate plans, and to do that quickly. The key thing here is that this decade, before 2030, is seen as a really crucial moment to sort of get us on track, if you like, to slow down global warming. And so what we do have in the draft is a push for countries to redo your homework. Go and have another look, strengthen it's called an NDC, it's basically your country's climate plan, and bring it back, crucially, before the end of 2022. Now, is this binding? No. The countries were everyone's meant to put in NDCs, and India, for example, still hasn't ever since 2016. So it's words, of course it's words, but yes, the language reflected in the text does mark a slight cranking up.
Okay. Thanks to Emma Ross-Thomas, our COP editor on the ground in Glasgow, on the communique, what it means in reality. Still that gap between the rhetoric and what is actually being implemented across these different nations. That is it for the European Market Open. Surveillance Early Edition is up next. Currently, your markets are flat across Europe, paired some of the earlier gains. That at the state display, 56 minutes into the trading session here in Europe. Plenty more ahead. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B. They're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now. It's a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
These businesses will be more focused. There'll be a higher, greater level of accountability. We should have sharper capital allocation, more strategic flexibility. And frankly, I think it's going to be good for the team.
We know our corporate travelers want electric vehicles to go visit their clients and do business in. And specifically, they want Teslas.
I am confident, yes, that we can get there. Human beings created this problem. Human beings can solve it.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Inflation jitters. Chinese data highlight the pressures building in the global economy. U.S. CPI is due out today. Joe Biden backs away from the immediate release of oil reserves. WTI and Brent extend gains. Plus, we're live in Berlin at the Super Return Conference, where we'll be speaking to Ftse, KKR's co-head of European private equity. Now, first thing is first also, happy Wednesday. I know there's quite a lot of market action. Together with that inflation data out of China, factory orders at a 26-year high, putting a bit of pressure overall on some of the 10-year, but just a repricing expectations ahead of the U.S. CPI data in the U.S. You can see the 10-year 147.11. A lot of focus, of course, on crude. We have Brent crude. We could have also showed you WTI. We had a report from the IEA and the EIA, not to get confused, but we understand for the moment that the U.S. does not think there's a need to release strategic reserves. They also think that the oil price will eventually come down and stabilize. Iron ore, again, it's a story about buildings in the U.S., in China rather, and Bitcoin 66,637. Now, the first thing we need to look at also is the equity markets, of course, in Europe. So overall, I think they're moving a little bit sideways. The UK, I mean, there's an incredible story. I think M&S is actually flying off the shelf. It's gaining some 14% after they had to update some of their guidance. Not only is the food doing very well, but also people want to go back and buy in store what they're selling. So you can see the Ftse there gaining some 0.3%. Similar gain for the Ftse MIB, bit of pressure for the CAC 40 and the DAX over in Germany. Now we're joined by Davide Serra, Chief Executive and founder of Algebris, an asset management company he founded in 2016 and now recognized global leader in financial equity and credit. Now, prior to Algebris, Davide was managing director at Morgan Stanley, where he headed the European Banks research team. He was also awarded the Young Global Leader designation by the World Economic Forum, recognized one of the leading experts on financial services. So we're so delighted, Davide, to have you on and in the studio, I think for the first time since the pandemic started. When you look at some of the market pressures, I mean, we talk about inflation day in, day out, or central banks going to do a policy mistake. We talk about, the value of banks. Like, what's at the forefront of your mind day in, day out when you make investments?
Well, I think today the number one question is we are living in a world whereby you have inflation at around 3% on a global weighted average, and rates are about 0. That means if you keep your cash in your bank account, you're actually losing 3 from a real perspective. And if you take, in the US, for example, inflation expectation almost up to 4%, and the 10-year is 1, that means over 10 years, you lose 35% of your assets. And so what I think it's important to understand is how can you first protect this for our investor, family, pension plan? That's the number one. Secondly is I can see why central banks are in a way stuck. Because as we're coming out of a pandemic, they need to let escape velocity at the economic level, make sure we're out of this. Look at Europe, we're still falling back into the fourth wave of the pandemic. You have the risk of virus mutation. There are still many uncertainties out there, and I have a feeling that the central banks want to be 100% sure, because once they go, there's no way back.
So but what does that mean? First of all, I mean, when you look at inflation, right, if we see wages going up, but I don't know if you're paying your employees more, and maybe some of them are watching and will ask you for a raise, but it's very difficult to take it out, so that's not going to be transitory. And then we have a number of supply chain issues. So if that is not transitory, where do you find value actually in the markets? Do you just have to take much more risk?
Yes, I think, first of all, we have taken now for the last, we were probably one of the first one back 16 months ago to say inflation was a problem. And second, immediately we said it's not transitory. Let me tell you why it's not transitory. It has to do with human nature. We have COP26. We had 1 billion people in the 1800. We're now to 7 and going to 10.
Yeah.
So for the next decade, each year, we're adding more human beings than ever been on the planet till 100 years ago. And so inflation is becoming a physical phenomenon. It's called water, it's called clean air, it's called energy access.
Right.
And hence, all these central bankers looking at the equation on the old world, they're just getting it wrong.
But this is a problem also for investment, right? I hear this more and more, is that we've stopped investing in the old world, but we haven't also invested enough in the transition. So if you see shocks left, right, and center, and what you're suggesting is that maybe central banks are doing a policy mistake, what does the world look like in 7 months? Interest rates at 3%?
Well, no, I think my view is as follows. I take the concept of inflation as a cumulative integral of what happened in the last 10 years. So basically, if you had inflation at 2 and rates at 0 for the last 6-7 years, and you kept your cash in a bank account, you lost already 10-15%. Now, I think time reverse, and that means that eventually central banks will have to hike, but we will keep these negative real rates for a little longer. Now, probably the best they can get is to neutral rates, means inflation to central bank rates at 2. That is the maximum they can achieve for the simple reason that between pandemic and what we spent, now the level of debt is too high. So we can't pay for it.
David, I have a million questions on banks. We'll get to that in a second. But actually, there's also the DoorDash.
Yep.
This is the home delivery for food, jumping 19% after it did a acquisition of Vault, and it beat in the third quarter. There's the metaverse. What do you do with this new world of technology, but also energy transformation?
Well, I have to say, for us, as we are main investor in the credit and financial space, we're focused more on the real world. And so anything that is metaverse, and we leave it to others.
I mean, when you speak to a lot of financials, chief executives, though, banking chief executives, they tell you, I'm very good on fintech. We're doing this. The platform's amazing, but actually, shareholders or at least analysts don't seem to price that in. Do you think there's a mismatch with what certain banks, Santander and others, are doing on the technological front, fintech, that's not being translated into earnings per share?
Well, I think it's a question of timing. If you think about it, basically, the banking as we know now was made in the late 60s, early 70s with the first mainframe. And then they upgraded the technological system. For example, if I'm in Bloomberg today, I can see everything is cloud.
Yeah.
If you go in a bank today, they have two systems. They have the cloud system and they still have the old system. So they're actually paying for two engines. Yep. Now, the old engine is running off, and over the next couple of years, you're actually going to see cost savings because they're basically ditching the old IBM mainframe. And as they go fully cloud, public and private, then I think at that point you'll see the classic network effect we have seen in some of the tech company. But you'll only see this in the next couple of years.
Okay, but you're still giving me the first interview in the metaverse, right?
Yes.
I need it like locked and loaded. Like I get the first Davide Serra interview when we move to the metaverse universe. The chief executive of Algebris, of course, stays with us, and we'll talk a lot more about banks. Coming up, inflation running hot. US CPI is out later. Economists expect to see the highest figure since 1990. So we'll discuss that next and what it means for banks. This is Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I want to be, I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at you'd have to look at what was you're defining as strategic or critical.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. France's Emmanuel Macron has sought to rally the nation, presenting a bright outlook for the economy in a national address. The president warned older people they must get a booster shot or see their so-called health pass deactivated, stopping them from going to cafes or restaurants. Meanwhile, U.S. Vice President Kamala Harris is embarking on 5 days of diplomacy in the country as she looks to heal a rift between the U.S. and its oldest ally. She'll meet the French president at the Élysée Palace later today. Now, Bloomberg sources say U.S. President Joe Biden and his Chinese counterpart Xi Jinping are scheduled to hold a virtual summit next week. It comes as the two nations spar over Taiwan. An alarm grows in Washington over Beijing's expanding nuclear arsenal. Producer prices in China are rising at their fastest pace in 26 years. PPI climbed 13.5% from a year earlier, ahead of economists' forecasts of a 12.3% gain. A global commodity price rally and output curbs caused by a power crunch are adding to inflation. And U.S. climate envoy John Kerry says he sees the COP26 negotiations producing a deal on carbon trading rules. An agreement would mark a turning point for climate diplomacy, but a complex set of technical rules still needs to be hashed out. Kerry told Bloomberg he does remain optimistic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, stocks and equity futures actually trading kind of sideways. Again, investors waiting that U.S. data report on consumer price to assess the risk of tighter monetary policy. Treasury yields are climbing. Earlier on, there was a little bit more pressure because we were worried about inflation in China actually reaching other parts of the world. So we'll follow that very closely. Investors also keeping an eye on China, Evergrande Group, which faces a payment test on dollar bonds. Now we're back with Davide Serra from Algebris. Davide, we talked about inflation. We talked a little bit about some of the risks out there. I want to talk about your wheelhouse, the banks. When you look at some of the banks, what's your top bank right now that you want to be invested in?
Listen, I think they're all the national champion across the Eurozone. For the simple reason that, these are the institutions that in a way paid the most the negative interest rates environment we had for the last 10 years. It's like if you had a normal business, rather than making positive revenue, they were almost making negative revenue. You need to have a branch, you need to pay people, and when you get cash in, you actually lose money. You can't even make money. And so I think this is about to reverse over the next 2 to 3 years. And so as inflation is clearly not transitory, but it's permanent here, at least for the next 3 to 5 years, what we're going to get is central banks over the next 12 months are going to move. Yep. And once they move, what happens, financial institutions will have better revenues. And that will translate, given the gearing, down to bottom line profit.
But I just don't know how you make some of the European banks work. So if you look at the US and some of, the investment bank, I mean, it just feels like the better you are, I mean, it's winner takes all. It's like you're either the best or actually you just struggle day in, day out.
Well, I think there are two issues. The first one, remember, in the US, you now have, take the top 5 institutions. 30 years ago, when I started in this business, the top 5 had less than 10% market share. Now the top 5 in America have more than 50% market share, and they have 50% market share of the US. Yeah. When you apply this to Europe, because of its fragmentation, the top 5 have less than 15 to 20% of the European market, which is same size as the US. So first of all, they need to take bigger market share. Secondly, though, at the same time, the rates environment is different. In the US, they can make 100 basis points more simply because of the rates curve. In Europe, you can't, and that's going to change. But what I think is the clear gap has been right now the capital level in Europe are almost higher than they're in the US, which has been the key problem for the last 10 years. And secondly, as I said, I think they're going to get pricing power coming from the rates environment in the next 3 years.
David, what's your take on Italian banks? So first of all, there's definitely a veil of optimism over anything Italian because of Mario Draghi that seemingly in the markets with investors can do no wrong. But then this Monte Paschi di Siena, UniCredit was going to buy it, they're no longer buying it. I mean, what happens to it?
Well, I think, first of all, if I see across Europe right now, it's fair that investors believe that Mario Draghi is actually the best leader. We've seen it with the Green Pass. He made it compulsory for everyone, including public sector employees.
We just don't know how long he's staying there.
But the reality, well, at least, the good news is he has a massive support from the country. And he's taking tough action and bold action, and they're actually paying off as the lowest number of infected COVID cases, being at the center of the COVID pandemic 2 years ago. Secondly, Monte Paschi, it's in a way, right now, is the only isolated cases. This is the oldest bank in the world. 20 years of this management, end up creating losses for every 100 euro loans they granted, they lost 33. It's just quite extraordinary. And so basically it's a one-off. I think right now, given that the talks collapsed, they're better off running it and slimming it for the next 3-5 years, keep on cutting costs. Eventually will be so small that it'll be able, to be sold separately. But it's obvious that from a UniCredit perspective, if you want to anticipate the net present value of cost cutting and capital, and in a way higher standard that the ECB requires for UniCredit, then there was, the bid offer ask was too wide.
David, are we going to see consolidation finally in Europe, or is there still not enough appetite for it?
I think, well,
cross-border.
Yes, cross-border, not yet. I mean, cross-border is very simple. Once the legal framework for granting a mortgage or a credit card or a corporate loan are identical in Europe, then you're going to get cross-border. It's the legal framework that matters. It ain't the tech plane, it's not the technological platform, it's just the legal framework. Right now, it's not. And as a result, banks have no competitive edge in granting a mortgage, from France into Italy or Germany. It's almost illegal, meaning that something goes wrong, you need to go to a local judge with a local policeman, and hence you don't have any economy of scale like you do have in the US.
Davide, thank you so much. David Serra, their chief executive and founder of Algebris, stays with us. Coming up, Tesla loses nearly $200 billion in market value in its biggest back-to-back sell-off in 14 months. We have that story next, and this is Bloomberg.
past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Ready to pay more and pay out more in terms of bonuses too for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, you know, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now let's get to Tesla, which has lost some $200 billion in market value in its biggest back-to-back sell-off in 14 months. Well, Bloomberg's Craig Trudell covers the global car industry and joins us now. Craig, I mean, it's absolutely quite amazing to see exactly, you know, the volatility of this all. Were you surprised to see shares react this way, you know, to the Musk poll, but also then there's someone else who tweeted that he could have trouble with his own debt?
Yeah, I think the drop makes about as much sense as the rise did. So I think we're seeing a little bit of irrational moves in this stock over the last few weeks. I mean, Musk himself was a little bit confused by the reaction to the Hertz announcement. That was an announcement largely actually from the Hertz side, where you actually from the beginning saw Musk tweeting about the idea that this doesn't really affect Tesla's fundamentals. We saw this huge run up in the stock regardless, and since then we've had a really adverse reaction to his poll over the weekend. It's definitely a significant chunk of shares, but it's also been the case that we've seen this company issue shares and make moves that maybe would normally trigger a drop in the stock, and that hasn't happened before. So I think both on the way up and on the way down, the moves have been a little bit more pronounced than you might think just looking at the announcements.
Craig, never dull. When you look at Elon Musk, and first of all, does he care that the share price goes up and down so much? I imagine yes, because it's also tied to his personal wealth. But in terms of his character, does he actually want to put an end to the volatility of it all, since it's actually because of his tweet that it started?
He seems to sort of enjoy the chaos, and I think that's one of the biggest issues here. Is if he were to stop with the Twitter shenanigans, maybe we would see the stock calm down a little bit. But he definitely does like the attention. He likes to be part of the news cycles, and sometimes that works to his benefit. I think what we've seen just in the last few days that it also works to his detriment and to Tesla's detriment.
Okay, Craig, what are you watching out for in the next couple of days from Elon Musk and Tesla? Is it just the tweets or something else?
Well, the fundamentals of the business are awfully strong. I do think that there is still a healthy debate as to whether or not those improving fundamentals justify the $1 trillion valuation. But I think there is a tendency on the part of Musk to sort of be his own worst enemy. So I think as long as he kind of stays out of his own way and there are no sort of repercussions for the tweets over the last few days, we may see a little bit of a calming down, or so we can hope.
Thank you so much, our auto car czar globally, Craig Trudell. Now we're back with Davide Serra from Algebris. Davide said, if I don't get to talk about Tesla, I won't come on TV today, right? Because you can't wait to get stuck in. I mean, I don't know whether it's symptomatic of something else, whether it's actually a lot of the cheap money out there, or whether Tesla's part of the energy transition. Like, we have some of these big stories, and I don't know how they translate into your world, whether it's, you know, taxation, whether it's energy transition, or whether it's just volatility in certain stocks.
Well, I would say, firstly, the technological let's say, enhancement that Tesla's brought to the real world are clearly extremely valuable. Secondly, though, for example, if you think about COP26, the key question that should be asked is, what's the planet boundaries footprint of a Tesla? Meaning, when you take the the lithium for the battery, and you see how electricity is produced, they're all in. Is it better, for example, than a Toyota car, with fossil fuel and then hybrid battery? This is a question. And some engineers
But it's cooler, isn't it?
And some engineers are debating it. Well, right. Cool or not cool, it doesn't matter. Here we have a problem. Right. We have basically 400 gigaton of CO2 that we can emit, and then it's kind of game over for everyone, whether you own a Bitcoin or you don't. So the reality is, I think the framework which we're analyzing is how sustainable this is. And clearly, I think in some tech stock, in NASDAQ, in some multiples, in other type of asset classes, you clearly see, in my view, the froth of negative interest rates for the last 10 years. Yesterday was interesting with the team. We found 10, 15 coins which probably have zero value that went up 7,000 times. So you put $1,000, you get $7,000. So hey, when did you put $1 billion, and then suddenly you're worth $7 trillion? So it's easy. You want to be the new Elon Musk? Just put $1 billion in one of these coins. You can go up 7,000 times. So rather than being 1 trillion, you have 7 trillion.
Unless it goes the other way, and then you lose 5 trillion. All right, Davide.
Which is the reason why we think these negative rates have probably done enough harm by now.
Davide Serra, as always, thank you so much for joining us. Chief Executive and Founder there of Algebris. Coming up, Ftse, the co-head of European Private Equity at KKR, talks to us ahead of his keynote speech at the Super Return International Conference. We're live in Berlin next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Inflation jitters. Chinese data highlight the pressures building in the global economy. U.S. CPI is due out today. Joe Biden backs away from the immediate release of oil reserves while WTI and Brent extend gains. Plus, we're live in Berlin at the Super Return Conference where we speak to Ftse, KKR's co-head of European private equity. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, stocks and equity futures pretty much steady, actually. They did start the day on with a bit of pressure on the way down. Now they're stabilizing. A lot of the focus will be on a U.S. report, of course, on consumer prices to try and assess the risk of tighter monetary policy. Treasury yields are climbing. When you look at some of the value sectors, energy and banking actually on the up. Consumer companies and drug makers seems to be trailing. And then the one thing that we need to keep an eye on, of course, Tesla gaining in European trading after its worst sell-off since September 2020. And then M&S. I love this story because it's one of the biggest gainers that we've been talking about, the turnaround of this iconic UK company, Marks & Spencer's, for the last 5 years. And now they're saying that guidance is doing well, sales in food is doing well, and so is closing. That stock price is gaining 15.5%. Now, today we've had a lot of companies reporting that's giving us an update on the global supply chain crunch. For more, we're joined by Bloomberg's Lizzie Burden. Lizzie, thank you so much for joining us. So Adidas, when you look at the results, what they tell us on supply chains and margin pressures?
Yeah, well, the shares are up this morning, and Adidas has taken a €600 million hit because of the Asia issues. You've got the consumer boycott in China, and in Vietnam, supply issues, this resurgence in coronavirus cases that's led to factory shutdowns and labour shortages. Just this morning, one of Adidas's key suppliers in Vietnam said that about 6% of its workforce had quit, and that was going to make it difficult to fulfill orders. If you contrast it with rivals, Nike also had to cut its forecast, but it's still more upbeat than Adidas. And Puma raised its forecast because it pivoted supply to China. But all three are going to be hoping that the Biden administration pumps more vaccine donations into Vietnam to ease this situation.
What about Infineon?
Well, it's a different story for Infineon. The shares are up. It's one of the biggest gainers on the DAX, and it's raised its forecasts for 2022. Infineon's a major supplier to car makers, which have been hit by this global chip shortage. So it comes back to the diminished factory capabilities. But Infineon's taking advantage. It's leaning in, investing, and the CEO says that he sees demand for semiconductors lasting into the longer term.
Lizzie, thanks so much. A great update there from our Lizzie Burden. Now, we're just getting some breaking news from some advisors, actually, of Angela Merkel, saying the ECB should communicate its normalization strategy. Now, we've had a couple of interviews, of course, with Christine Lagarde, the president of the European Central Bank, and it always is at pains of saying, well, look, you know, once we taper, it doesn't mean that it's an interest rate rise, but we haven't really seen a laid out strategy. So that's just the latest from advisors there from Angela Merkel. Now, coming up, we're back in Berlin at the Super Return Conference, where we'll speak to David Blitzer, also from Blackstone. So that's coming up, and this is Bloomberg.
click on it, we make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they are needed most.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition, and I'm Ftse right here in London. Now, KKR is one of the world's leading investment companies, and it manages multiple alternative asset classes, including private equity, energy infrastructure, real estate credit, and through strategic partners, hedge funds. Now, it has over $429 billion of assets under management with 109 portfolio companies. Its co-head of European private equity, Ftse, is due to speak later on the role that PE can play in the global recovery at the Super Return International Conference in Berlin. But before that, he's also talking to our Danny Berger in Berlin. Danny, take it away.
Francine, thanks so much. That's right. I am here with Ftse, which you just did get finished with the panel. So thank you so much, Philip, for joining us. A very busy day you have had. I do want to start on KKR's earnings last week. One of your co-CEOs said that KKR now, of importance to them, is expanding beyond the U.S. and specifically mentioned Europe. What does a KKR with an increased importance place on Europe look like?
First of all, Danny, great to see you, and it's so reassuring that we can all be here in person. If you keep in mind that 2 years ago, it was almost the super return here in Berlin, which was at the end of the pre-pandemic period, and now we're reopening it with thousands of people here, and it's good to see you healthy and in good form.
Likewise.
Thank you. In terms of Europe, it has never been more interesting to invest in Europe at this time. It is simply because this pandemic has amply shown that the main trends that we see in the world, i.e. tech penetration, the fact that aging societies really put a huge weight on healthcare systems, and lastly, sustainability, really people thinking about how the world is changing around climate change, etc., are being accelerated. And Europe, in most of those trends, is behind the US or Asia. So KKR, as an entrepreneurial investor, has a real track record in partnering with families, with entrepreneurs, with companies to help them leapfrog into that direction.
So if that's the kind of business, what are the sectors? What are some of the specifics where you're finding those gaps, you're finding those opportunities?
So I give you one statistic. The tech content of the S&P 500 is approaching 40%. In Europe, the same number is in the single-digit percent. So all of the European companies are grappling with tech transformation. That is a massive challenge for everyone. So our TMT sector, we have done more than 150 tech deals globally, is one of its kind here in Europe, because what really our partners are looking for is, of course, the Europeans on the ground, but more importantly, the ability to talk to what's happening in Silicon Valley, but at the same time, what's happening in Asia.
Tech's not cheap, though.
It is not cheap, but we have a big opportunity for growth. And Danny, what KKR is maybe doing a little differently from others is that through these partnerships, we're able to get into these transactions a little bit better, because our partners are not looking to optimize the price right at entry. They're looking to optimize the value creation over time in the overall equation, both at the entry and at the exit.
So along with all of Europe, you really have led part of the effort to build out KKR's presence in Germany as well. Of course, we find ourselves in Germany and Berlin right now, and we find ourselves in Germany with a new leadership, the SPD likely taking the chancellery, the traffic light coalition, with a more left-leaning, let's say, government coming into power. How do you view the business environment in Germany and specifically for private equity?
Danny, the air of change is coming to Germany. You think about the coalition that we're talking about. It's a combination of the fiscally conservative Liberal Democrats, the socially liberal Social Democrats, and then the reform-orientated, forward-leaning Green Party. It's a very German, phenomenon that you make that work, all three together. But it gives us that air of change that people are embracing all the meta trends that I just talked about. Technology is very much a liberal domain. Of course, climate change and sustainability, the Green Party. And the fabric to make it all work for all is something that the Social Democrats are known for. So as KKR, we see that very positively, and we believe it will further accelerate the investment opportunity here in Germany.
Is inflation a problem? Christine Lagarde says that it's temporary, as many central bankers do. Do you agree, or is this an issue for Europe?
I mean, macroeconomically, central banks have tripled their balance sheets. As we come out of the crisis, it was clear that bumps would occur because of that. We have to discern between short-term supply chain disruptions and other inflationary trends that result from that. And then long-term, how do we get out of that monetary and fiscal accommodation without creating long-term inflation? We as thematic investors believe the best we can do is on the micro level, invest behind companies that have pricing power. Many of these tech, healthcare, and sustainability companies that we invest behind do have that pricing power.
Let's get into that sustainability question, because KKR has doubled, or plans at least to double, their ESG investing team. What does that look like for you? What have you had to change as ESG investing becomes more important for your investors?
I mean, you refer to our co-CEOs, quarterly announcements they made, where ESG clearly is one of the key thematic trends that KKR is leaning in massively behind. Here in Europe, it's one of the areas where Europe is ahead of the world, quite frankly, in terms of Asia and the US. That means our more, forward-leaning private equity fund will be Article 8 compliant, which means we not only incorporate ESG criteria across the firm in everything we do, every investment, the criteria, we measure it quarterly, we publish it annually, but we think proactively ahead, what can be investments that can represent societal changes and improvements in ESG terms.
So, Philip, unfortunately, we have less than a minute left, but just quickly before I let you go, private equity has done very well, did well through the pandemic, has come out on the other side. What are you still worrying about? What could derail the rally?
Danny, it felt pretty lonely in April 2020. We were investing 3 times more than we usually would during that crisis. It felt scary, but in the end, we were right because of that focus on the themes we talked about. Coming out of the crisis, my concern is that overall people potentially put too much leverage in the system. But as long as you stick to those trends and create fundamental changes to your investments, you will be coming out very well on the other side. And that's really what differentiates KKR, our sustainable investing approach, and within Europe, that partnership approach around these themes. With that, we go optimistically into the future.
Philip, so great to catch up with you today. Wonderful to be in person here. Francine, that's Philip Ftse, the co-head of European private equity at KKR.
Wonderful, talking about some of the sectors, of course, that we should be watching out for. Danny Berger there in Berlin. Now, coming up, we talk oil, paring gains. That's as President Biden backs away from an emergency release of crude reserves. We discuss that next. Price of oil going forward. This is Bloomberg.
engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is, is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, in between his time as a senior executive with U.S. alternative investment management company, the Blackstone Group, David Blitzer mixes his investment and business prowess with his passion for sport. He's an owner of the Philadelphia 76ers, amongst interests in many other top sporting outfits in the U.S. and Europe, including English football club Crystal Palace. Danny Berger is getting to sit down and speak with him ahead of his appearance at the Super Return International Summit in Berlin. Danny, over to you.
Francine, thanks so much. Yeah, I don't doubt David and I might get into a little sports chat, but first off, David, so wonderful to have you here with us in person at this conference. Thank you so much for joining us.
No, it's a pleasure.
So you started TAC Ops back in 2011, and of course you were the first really to adopt this style, but since then, a lot of other players in the space. You have Ares, you have Apollo. I won't list all of your competitors, but what's had to change in the past decade to really stay at the forefront of this type of strategy?
Well, again, thanks for having me here. It's always a lot of fun. Look, I mean, we started this strategy about a decade ago with a pretty clear view of having the most flexible pool of capital that we can in order to create completely different solutions for our partners in business, but also have a differentiated product for our investors. And I think we've achieved that over the period of time. And of course, if you do something that's innovative and new, you're going to have folks who look at that and go, wow, does that make sense for me or my firm, et cetera. So I think, sort of people that have sort of copied the strategy is flattering at the end of the day. And the good news is we like good competition. It's fine. I mean, the reality is we have less competition in what we're trying to do within TAC Ops than you do in most areas of the alternative space. But I think we'll continue to have, more competition over time. And for us, it's really been a journey to continuously improve on what we do. And that's both within the TAC Ops business itself and also how we work together with the rest of our firm to continue to create more and more value for our business partners out there.
Right. It's fascinating because TAC Ops, when you founded it, the idea is, okay, these are areas that are typically ignored. Well, if they're not as ignored anymore, what has that done to the assets that you chase after?
It's just, twofold. One, there are oftentimes more people looking to create a structured solution, let's call it, with a company than there would have been in 2012. The flip side is there's more companies that understand what we're trying to do. And so you have both an increase in supply and an increase in demand. And so it's actually still been a very nice balance for us in terms of our deal flow and our partnerships.
You said a bit of a buzzword for me. I know you didn't mean it, but supply. I have to ask, have you been able to take advantage of any of these supply chain disruptions we've seen?
Not in that sense. If anything, it's actually been an issue. So we all know we're seeing incredible supply chain disruptions. One example, I was with one of our CEOs last week who was talking to me about what was happening on his, container shipping and what it was costing him. And it was about an extra $40 million a year just to move goods from Asia to the U.S. He sends about 13,000 containers a year, and it's about $4,000 more a container. So that was just a really stark example. We're seeing that really all over the place. What I think might happen is that companies will need capital, right, to either consolidate in some cases or just withstand what's happening in the environment for a period of time. I do believe the supply chain disruptions are starting to get better and will dissipate over the next few quarters, but it might create some investment opportunities for us with those businesses, but it has not yet to date.
So, David, to start our conversation, Francine, when she introed us, I know you couldn't hear it, was talking about your business, the Harris Blitzer Sports and Entertainment, which, of course, you founded with the co-founder of Apollo. So we have to get into this a little bit. I know through that, your investments include the 76ers, New Jersey Devils, Crystal Palace. There was a point where sports teams were a bit of a trophy investment. What's changed?
So I completely agree that was the perception.
Right.
It was not the reality. But I think the biggest thing that's really changed is that people have realized at their core, these are amazing businesses in terms of the creation of content and then ultimate value of media rights. So when we originally got involved in the sports business, I'm pretty simple in a lot of ways in terms of breaking down investment theses. To me, it was about the value of media rights, and it was about the scarcity value of teams. So we talked a little before about supply and demand, which I think about endlessly. You're not creating more of these teams, and the demand for them is clearly going up. So what's going to happen? Values are going to appreciate. And then, again, they're fundamentally media businesses. And we're huge believers in content. I'm a huge believer in content and content creation. And so I actually think they are quite investable, having nothing to do with historically maybe people did them because they came from a certain city or, they were sort of proud on the sports. For us, I'll speak for myself, it was a great business decision. I do happen to be passionate about sports, but not to do something that didn't make, economic sense.
Right, and to be able to put your TAC Ops hat on as well. I mean, are there any areas in sports that have been ignored that kind of also fit that same idea of this is somewhere in the market that there's a gap that we really have an advantage to grow this business?
Well, I think the reality is, number one, you're seeing businesses grow dramatically from an international standpoint. Variety of sports businesses. And I think you're also seeing institutional capital come in to the sports business. I mean, in a dramatic way in the past 12 months. And my guess is that is going to continue unabated. So I think there'll be more and more more institutional investment opportunities in sports. For us, we think more about the media and entertainment side of the equation. Again, we talked a little bit about content, and content creation is one of our big themes at Blackstone. And so when you think about it from that perspective, there's quite some interesting, things to do over time.
David, thank you so much for joining us. I'm afraid that's all we have time for. You'll have to come back and join us again soon when, things are back to normal and you can travel on over to London. Francine, that's David Blitzer, global head, I should say, of tactical opportunities at Blackstone.
Danny, thank you so much for a great interview there, looking at some of the opportunities out there. Now, oil paring gains after the Biden administration backed away from an immediate release of crude reserves. The White House was weighing the merits of tapping the supply after OPEC and its allies refused to increase output at a faster pace. Well, we're joined by Will Kennedy, who oversees all of our energy coverage as executive editor. Would they not, Will? In the end, actually, the U.S. believes that prices stabilize, but do they think that they stabilize on their own, or do they think that OPEC will intervene?
So the U.S. administration hung a lot of weight on this monthly report that was published yesterday called the Short-Term Energy Outlook. Normally a very mundane thing of interest mostly to oil analysts and oil traders, but it took on more importance yesterday. But that report actually said that the Energy Information Administration, the arm of the U.S. government that looks and assesses energy markets, thinks that the market will not be so tight early next year, that there'll be a little bit better balance between demand and supply. And I think that persuaded the administration that an immediate release was not in fact necessary. So the perverse impact yesterday of this report that said, oh, the oil market's not as tight as we think, is that prices actually rallied. But as you say, they've come off a little bit today. I don't think that we should rule it out forever. I think that clearly the administration wants the market to believe that it is ready to act to control prices. Elevated gasoline prices remain a key concern for the US administration. They're very high. But the immediate prospect of an SPR release looks to have receded.
Well, what exactly is driving up prices? So is it very difficult to see where demand is coming from because there are stop and starts parts of the world, including supply chain issues, or is it actually that there's just not enough oil out there because OPEC is holding back?
There is patchiness in demand, and of course people would be concerned about things like the spread of the virus in China, but overall demand is extremely robust. We've got the resumption of more transatlantic flying this week, which will quickly add to jet fuel demand. Diesel demand around the world is extremely strong. If you feel, going back to China, if you think about something like the energy crunch in China and the fact that they are trying to dig a whole Poland worth of coal in a few months to avert their energy crunch, that takes an enormous amount of diesel. So diesel demand, for example, in industrial production is surging. Petrochemical demand remains very robust. So this story of the recovering global industrial economy is still very much in place at a time when OPEC is increasing supply, but slowly, and for now, increases in the US remain muted.
Are OPEC countries transitioning to a greener economy? And this is kind of the million-dollar question, especially, that they're asking at COP26. Do we see, and I know we've spoken about in the past when peak oil will be reached in China and elsewhere, but I mean, how do they manage this? Difficult.
Prince Abdulaziz is actually in COP26 today, where it'll be interesting to see what reception the Saudi oil minister gets at this climate conference. The background to the conference is very strong demand. We've talked about coal, we've talked about oil. Yesterday we heard from the CEO of Vitol, the world's largest oil trading company, and who said that globally oil demand is now back at 100 million barrels a day. It's now back at where it was on the eve of the pandemic. And I think that's a real wake-up call to people about how slow at the moment the transition is and how much work there is to do, despite all the good intentions stated in Glasgow over the last 10 days.
Well, thanks so much. Will Kennedy there. We'll be watching with great interest. The Saudi oil minister, of course, showing up at those COP26 talks in Glasgow on renewable energy. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
фундаментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. Ну, то есть второй будет проще.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Do you enjoy being a senator with all this pressure on you? Is this fun, or is it not that much fun?
My dad always said, if you can say no with a tear in your eye, you might be okay. And I've been crying a lot lately.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Fed is navigating the most difficult period in its history since the Volcker area.
If you look at the broad inflationary dynamics, they remain largely pro-cyclical.
Inflation is rising sustainably. It is not transitory. The procedural base effects have rolled off and inflation's still going higher.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Wednesday, November the 10th. Our top stories today. Inflation takes hold. The risks are building in China, where factories see prices rise more than 13%. In the U.S., consumer inflation may be rising at the fastest pace in more than 3 decades. The virtual summit, President Biden and China's Xi Jinping plan a long-distance meeting next week. At the same time, the president tries to keep his domestic agenda on track. And electric vehicle makers in the headlines, but not for the same reasons. Rivian has the biggest IPO of the year. Tesla's market cap falls almost $200 billion in 2 days. And we will talk climate change with the CEO of Polestar. A warm welcome to the program, everybody. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards, live in London with Matt Miller and Lisa Abramowitz in New York. Kaylee Lines is off this week. And Matt, as you look to check these markets, it is inflation, inflation, inflation. That is the big story of the day. We've already had some high factory gate inflation numbers out of China.
Yeah, and we've had some really high PPI numbers out of the U.S. as well. Yesterday, they came in at 8.9%. year over year. Take a look at what's going on in Asia. You can see that we've got a little bit of a mixed market here. I will tell you things looked worse before we got some positive news from the Chinese property developers dealing with their bond issues. So we've had a little bit of improvement. For example, the Hang Seng in Hong Kong now up 0.75%. But the CSI 300 on the mainland is still down 0.5%. And the Nikkei in Japan down 0.6%. You can see the yen right now at 113.18. You can now buy a little bit more Japanese yen for your US dollar. So the dollar is strengthening. In terms of what's going on in Europe, you've got a mixed picture there as well. Europeans will be watching the CPI numbers today very closely. Here you can see the Ftse is gaining 0.5%. Great grocery store news there. You've got the DAX unchanged, the CAC down, the IBEX up a little bit. So a mixed picture, and I think really global markets are waiting, Lisa, for this CPI data to come out later today.
Yeah, Matt, perhaps they're waiting for CPI. It's sort of unclear what exactly they are waiting for, but they are in a sort of holding pattern after reaching record highs for 8 consecutive sessions here in the United States. We saw a pause to that record rally yesterday, and today an ongoing pause, but little change. The S&P 500, it was basically just a touch lower. If you want to take a look at those boards, you can see it's just down about 0.1%. 0.1%. Also, the Bloomberg dollar, spot dollar index is actually gaining today, and you're seeing it pretty much across the board versus the yen, versus the euro. I wonder how much this is strength being built into the expectation of a more hawkish Fed on that CPI report, which may come in, as Anna was saying, at the fastest pace in decades. Two-year yield is quite interesting to me. You are seeing a bit of a lift here after many days of a downward draft. How much do people start to reassess the potential for rate hikes as a result of the inflation data? What will be enough to get a sense of whether this is more than just a transitory, I know it's a dirty word, but transitory type of inflationary push? And crude, this is actually quite interesting. Earlier today it was higher. Now it's just a touch lower, down 0.4% on the NYMEX. You can see it at $83.78 a barrel. The idea here was that the U.S. was largely expected to come out yesterday and say, we're going to release some of our strategic reserves from our petroleum holdings. They did not do that. Anna, that actually led to a rally in oil prices. It seems to be coming off, but this really is a focal point as we head into next year's midterm elections and as people continue to go and pump up their cars.
Yeah, that absolutely seems to be what oil markets are focused on. Will the U.S. or won't the U.S., will the White House move on the petroleum reserves released from there? Let me just get to some breaking news. A red headline across the Bloomberg around Google. Google loses an EU court fight over $2.8 billion of antitrust fines. This is a boost for Margherita Vestager, of course, the competition regulator here in the European Union, getting a boost for Vestager in the crackdown on tech giants that has been very long running. This EU court ruling in the Google shopping case can be appealed, though, so we'll look for if there are going to be further developments there, if there will be an appeal. But the headline at the moment is that Google loses that EU court fight, and those fights with EU courts have been long-lasting for Google and Alphabet. Now, let's take a look at some of the items that are on our agenda for the day ahead. Now, Super Return, the world's largest private capital event, is happening in Berlin. That is a focus for us. Danny Berger on the ground for us there, giving us the lowdown on the private equity sector, essentially. Disney reports earnings after the bell today, so we'll focus on that. At 10:30 a.m. New York time, the EIA releases its latest crude oil inventory report. And to Lisa's point, really important to watch all of this data because it all adds to the picture we're getting about whether the United States wants to dip its toe into those reserves and release some. And at 8:30, the main event of the day, as we mentioned a number of times already, inflation is in focus, US CPI data, as well as jobless claims. Let's also remember the jobs side of things. For more on today's inflation data, we're joined now by Christine Aquino, who leads Bloomberg Markets coverage for us. Christine, very good to speak to you. Let's begin with the China data then, because of course we're building a global inflation picture here, aren't we? It's interesting that the PPI, the factory gate prices in China up by more than 13%, eye-watering kind of numbers. Back in the 90s, those were all passed on to consumers. It's a little less clear whether that really gets passed on these days. What was your takeaway?
Absolutely, Anna. I think that is kind of the main concern now, right? Is that factories, businesses might not be able to pass these costs on because consumers are already grappling with a number of higher costs when it comes to energy, when it comes to services and goods, right? And so they might not have the capacity to take on those extra costs. And I think that is the big worry. Also playing into questions over monetary policy as well. I think the reaction that we saw in Chinese shares today, very much a function of traders and investors questioning whether China will be able to ease given that inflation is at these levels.
Yeah, we'll get further analysis for the guests later on this hour on that. Lisa?
Yeah, Christine, I just am curious to wonder about the ripple effects of the faster inflation in China. For so long, people talked about China importing a disinflationary type of trend into places like the United States and Europe. What are we expecting in terms of the bleed through to the U.S., which also is reporting some inflation data at 8:30 today?
Well, Lisa, very much focused on what this inflation picture out of the U.S. is going to look like, right? These are the two world's biggest economies. And so if we see a picture where inflation is even more entrenched than perhaps policymakers were expecting, it will definitely have big implications for how policy is going to get carried out there and how markets will react to that. Already we saw the 30-year real yields in the U.S. hitting record lows this week in anticipation of this report. And I think we're going to get more clarity on the direction of that particularly important metric heading into today.
All right, Christine, thanks very much. Bloomberg's Christine Aquino covering markets for us out of London. Bloomberg has learned that President Biden and China's Xi Jinping will hold a virtual summit next week, but no specific date has been set yet. Still a very important meeting that we want to talk about with Emily Wilkins, Bloomberg government reporter, joining us out of our D.C. bureau. So what do these two, Emily, hope to accomplish?
So we don't know exactly what is on the agenda for Biden and Xi to talk about during this virtual meeting, but there have certainly been rising tensions between the two countries, concerns over Taiwan, different things that they need to do in terms of economy. One thing that you've really heard from both Beijing and Washington is that they want to make sure that they're not looking to escalate conflict. They're looking to find ways to make sure that both countries can compete without getting into that conflict area. And so we're definitely going to be keeping a close eye on what's coming next. President Biden and President Xi have spoken twice so far on the phone since Biden has become president. And while that relationship actually seems to be going pretty well, remember, we've seen a number of acrimonious meetings between Washington and Beijing officials earlier in this year, earlier in Biden's presidency. And so this seems to be the next step toward the leaders of the two countries trying to make sure that they do maintain a working relationship, even as tensions around other areas of the world are getting more intense.
Meanwhile, Emily, President Biden today in Baltimore will be trying to sell the $550 billion bipartisan infrastructure plan, explain why this will help ease supply chains over the longer term. What about the shorter term? What are we hearing out of this White House in order to get presents to people during the holidays, which seems to be an increasingly political issue?
Absolutely. Well, yesterday you did see President Biden meet with the heads of a number of companies, including Walmart. And the message that he tried to send from that meeting was, hey, this Christmas, there will be toys on the shelves. You will be able to buy your Christmas gifts. This is something we're aware of, and this is something we're working on. President Biden, you know, you've seen him do these meetings, give these speeches, put out these executive orders with an eye on trying to alleviate some of the rising costs of inflation as well as the supply chain backups. But to be honest, these are global problems. The White House can only do so much to really address them. And so what President Biden is trying to do here is give the impression that the White House is doing what it can, at least, to respond to some of these backups, but also trying to shift the narrative a little bit. Say, hey, come look at this infrastructure bill we just passed. It's huge in size. It's going to help people in all these ways. And this is going to be a talking point. This particular bill is going to be something Democrats continue to talk about and continue to sell from now until the midterms.
Emily, thank you very much for that. Yeah, when we talk to shipping companies, they point to shortages of labor to get stuff from ports to end destinations as being one of the key sticking points. Emily Wilkins of Bloomberg Government joining us there from Washington. Thanks very much for the analysis. Now to Berlin, where Super Return, the world's largest private capital event, is underway. And US-China tensions are among the concerns weighing on deal makers. Carlyle co-founder David Rubenstein spoke with Bloomberg's Danny Berger earlier.
I say the biggest geopolitical issue is the U.S.-China relationship. It's obviously not as pleasant as we thought it would be after Biden was elected. In fact, it's probably no better than it was under President Trump, maybe even worse in some cases. So as a result, I think people have to worry about investing in China or doing business with China. That's an issue. And also, what are the ramifications if the relationship gets worse? For example, suppose there's something happens with Taiwan, how is that going to affect the chip business, for example, so much of which is produced in Taiwan?
Danny Berger joins us now from the Super Return International Summit in Berlin, where she spent the morning. Danny, good morning to you. So what is the environment like then for now that this huge conference is taking place in person, I imagine for the first time in a while?
Yeah, the first time since February of 2020. And we have to keep in mind that private equity, private capital in general is bigger than ever. $150 billion worth of dry powder in the U.S. alone that these funds are sitting on, ready to deploy. So with that in mind, it is a very, very busy conference, despite the fact that this conference even tried to restrict how many people could come just because of the continued COVID concerns. But people want to be here right now. They want to meet face-to-face with their investors. Everyone I've been speaking to is so busy. They have conference rooms booked down at this hotel. I'm at the Intercontinental to meet with their different investors. You really get this sense that this industry has really just been thriving even throughout the pandemic, and it's really important for them to be able to get that face-to-face interaction, something we've heard from a lot of executives, to make sure that these deals get done and they keep their investors informed.
What are the biggest headwinds that the really rich people you're talking to at that conference are considering?
Well, you heard there, David Rubenstein is worried about China. After he said that, I asked him, okay, is China not an attractive place to invest? And part of what he said is you just got to be really careful. Well, being careful is the name of the game. I also spoke to a few people where inflation is a concern, especially coupled with the fact that the industry has a lot of leverage. This is something Philip Fryse, KKR co-head of European private equity, flagged to me. But this is also an industry, as I said, that did very well out of the pandemic. So a lot of them are concerned about this false sense of invincibility. So they really are looking for where the pain points are. Some of them, as I said, are really typical China supply chain inflation. But another interesting one is just how much money is floating out there. It is harder to find deals that are at a good value.
Nice problem to have, perhaps, Danny. Thanks very much. Danny Berger with us this morning. And she will be continuing her conversations at the Super Return event with the titans of private capital. Coming up, she's speaking with Ursula Burns, the first African-American woman to lead an S&P 500 company, the Integrum founder, Teneo chairwoman, Uber board member, ExxonMobil board member as well. A long list of titles there. Coming up on this program, EVs in focus. We'll speak with the Polestar CEO later this hour and the Rivian CEO later today on their IPO. And risks building. We'll talk about the latest data out of China with Freya Beamish of TS Lombard. This is Bloomberg.
Crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now. It's a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Lisa Abramowitz in New York. Anna Edwards is with us in London as well. I want to take a look at some of the stocks on the move in the pre-market this morning, starting with DoorDash. It is buying its Finnish rival Volt, which also operates in Berlin. I clearly use it a little bit too much. They deliver food to you on a pretty much 24-hour basis. It's an $8.1 million deal, and DoorDash also beat third quarter estimates. As a result, the stock is soaring in the pre-market, up 17%. Now, Tesla, we've been talking about over the past two sessions, has lost $200 billion in market cap. Maybe you're getting a little bit of a bounce here. Maybe investors are buying the dip. But Rivian is also an issue today. We're not seeing it move in the pre-market, but it priced at $78. It's going to be the biggest IPO of the year. It's going to be the sixth biggest IPO of all time, raising about $12 billion. So that's adding to positive sentiment for EV producers across the industry, and maybe that's helping out Tesla a little bit. Nvidia also is one to watch. It's the 6th biggest company on the S&P 500. Yesterday, briefly worth more than $800 billion. Analysts say the chipmaker's autonomous vehicle program is a threat to Tesla. It also is seen as a winner in the meta space, but it's down a little bit today, 1.2%. I should point out, year to date, Nvidia is up 135%. That's literally 3 times the year-to-date gain for Tesla. So Nvidia is definitely one to watch. Joining us to talk more about the autonomous vehicle space and what's going on in EVs is Craig Trudell. He covers the global car industry for us. And Craig, first off, I wonder about all of the drama about Tesla. What does this mean that Elon Musk had a Twitter poll? He's going to sell 10% of his stake. Maybe he already has. His brother Kimball apparently last Friday sold 88,000 shares of Tesla at $1,229 a piece. What does all this mean that the big stakeholders are liquidating a little bit?
It certainly isn't a good look, and it does raise a little bit of concern about the way that the sort of optics of this, right? You see, you've seen board members for some time now cashing in on the stock as it's risen substantially. I think this is also just a matter of, the rise up didn't make a whole lot of sense, even if you ask Elon Musk or sort of consult his Twitter feed. And so, we're seeing a little bit of a sort of comeuppance for what was a sort of hard to understand rally off of the Hertz announcement just a couple of weeks ago. That fleet order, Musk said, doesn't really change the dynamics or the fundamentals of the business. And yet the company soared to more than a $1 trillion valuation. It's still above that even after this huge sell-off the last couple of days. And so even if this sale is something that the market should be able to sort of swallow and take in stride, we're maybe seeing a little bit of sell-off because of the fact that the shares had jumped so substantially.
Yeah, there's certainly been a lot of news flow to keep across when it comes to Tesla in just a short number of days, Craig. Let me ask you about Rivian. For many people, listed EV car makers was sort of shorthanded to Tesla for a long time, certainly in the United States, but now we've got Rivian coming to the market. How significant is this as a player?
It's going to be a really interesting company to watch. I think they are sort of pricing their vehicles at a fairly high amount of money. So this will be a case where we'll see it, maybe like Tesla in the early days when they were just relying on the Model S, which was pretty expensive. The volumes won't necessarily be anything to write home about, but as long as they're able to perform, relatively break even or close to it, we've seen that investors have some real patience with electric car companies making money or not making money. And this is a play both, in the commercial space with a big customer in Amazon for vans, and also trucks and SUVs, which we know are the most profitable segments for the market.
Okay, one to watch then, Craig. Thank you very much. Bloomberg's Craig Trudell with the latest on the EV makers stateside. Now, coming up later, we'll be speaking to the Rivian CEO about the company's IPO. That's coming up later on programming. This is Bloomberg.
City.
In London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Lisa Abramowitz in New York. Now let's get your first word news update. The question of whether President Biden's tax and spend package will be fully paid for has gotten a little more complicated. The administration estimated that a better funded IRS could bring in $400 billion over the next decade through more audits of corporations and the wealthy. But under the budget rules, government analysts can't count money that will be spent as also increasing revenue. Democrats, moderates have been asking for a cost analysis. The UK won't join an alliance of countries fixing a date to phase out oil and gas production. The group is being spearheaded by Denmark and Costa Rica. It's expected to announce as many as 10 to 15 new members today at the climate talks in Glasgow. But the UK says it isn't joining because ending fossil fuel production could cause a cliff edge in energy supply. We'll have more for you on the markets coming up on Bloomberg Surveillance Early Edition. That's coming up next, including talking about where the ECB heads next. In fact, let's do that now. The European Central Bank would risk making inequality worse if it raises interest rates before ending asset purchases. That is according to Executive Board member Isabel Schnabel. She says hiking rates while continuing bond buying could disproportionately benefit richer people because of the assets that they hold. Coming up live from COP26 in Glasgow, we'll speak with the CEO of the EV car maker Polestar. That conversation next. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Lisa Abramowitz in New York. Kaylee Lines is off this week. Lisa, it is inflation day. We've had the numbers out of China. We've got inflation numbers to come from the United States. The CPI numbers going to be closely watched. Will we get a 30-year high on that inflation print? Interesting, Janet Yellen talking overnight saying this isn't like the 1970s. For all of those harking back to that era, just listening out for any echoes.
Anna, a lot of people in the market would agree with Janet Yellen on this. In fact, there are very few people saying this really will be a repeat of the 1970s. What it does, though, is it takes away some of the oxygen in the air when it comes to wages, when it comes to the real experience of consumers. Can wages rise in tandem with these rising consumer prices? If they can't, what does this mean for growth going forward, Anna?
Yeah, absolutely. I was interested in the comments by James Bullard as well of the Fed yesterday, talking about how the pricing power that companies have, that might sound like a good thing for those companies and for their margins, but when you're watching inflation, that might be something to keep an eye on. Matt, what are you thinking about as we head towards the start of the US trading day?
Well, I'm really thinking about CPI. I can't wait to see what that print looks like. We're expecting 5.9% year over year, and we did get the PPI that we were expecting yesterday, 8.9%. year over year. So I think markets are looking for it as well. You can see the stocks 600 live trade, the cash trade right now, unchanged at 482, 483. S&P futures are down just a little bit, 0.2%. But remember, we are hovering at record highs. We had 8 record highs in a row until yesterday. The 10-year yield coming up a little bit at 147.96. We had seen a lot of buying in treasuries. Now we're seeing a little bit of a sell there. And then Bitcoin right now, $66,868. We did see an all-time high of 68.5 yesterday, but still, I think this shows you how much cash is in the markets. By the way, in terms of the pre-market movers, I talked earlier about DoorDash. It's making an $8 billion acquisition of a Finnish rival, Volt. It's soaring in the pre-market, up 18%. Tesla's gaining back a little bit of value after losing $200 billion in market cap over the last 2 sessions. Tesla is still a $1 trillion company, so it stands to add a little bit to that today. And then Plug Power missed on third quarter net revenue. We know that these companies are getting punished if they miss in this earnings season, and Plug Power is down 3.5% in the pre-market. Anna?
Let's go to Glasgow then next. You were talking there about Tesla. Let's talk about the electric vehicle revolution. As COP26, the conference there prepares for Transport Day. Thomas Ingenlath is the CEO of the EV car maker Polestar. This company is calling for an accelerated shift to climate neutral mobility and increased transparency from the car industry in order to meet climate ambitions. The Polestar CEO Thomas Ingenlath joins us now from Glasgow. Thomas, really nice to speak to you. You clearly think the rest of the industry is moving too slowly. I suppose it's easy for you to say that, in a sense. They're clearly not going to stop producing petrol or gas and diesel cars tomorrow. So how fast would you like to see the rest of the industry move?
Well, faster than the decision that is going to be made here, talking about 35 and 40. This, I think at the end of the day, the consumer even will move faster than the industry is deciding here today. I think we should all go very quickly beyond that combustion engine question and go into the topics that, you know, EV market is just the beginning of sustainable transportation, and then we have to tackle the question of reducing CO2 emissions in the production process of EVs. So this, we should get really quickly onto those questions and tackle those.
Okay. Well, yes, but sticking with this, I mean, this is crucial, though, isn't it? The rate at which the competition in the market tries to keep up with the likes of Polestar in terms of the transition to electric vehicles, Thomas. I mean, do you think, is this something that the government should lead on? You mentioned consumers being in the lead here, but shouldn't we have governments making mandates, as we've seen in some countries, for the end of certain technologies?
It goes hand in hand. On one hand, I mean, look, we will have a great product portfolio in 3 years together, which of course will be a great offer to the customers. And I think there will be just a very natural drive towards EVs because of the superior technology and the great drive with it. But when it comes to providing green energy for charging, which is a crucial element of really driving EVs in a sustainable way, when it comes to charging infrastructure, of course, these are big, big questions for the politicians to tackle and to support the transition.
Well, and the owners of your unit. I mean, you're owned by Volvo, and the Swedes have taken a big step, but also by Geely, and the Chinese do burn a lot of coal, Thomas. Are Volvo and Geely, for example, willing to phase out all combustion engine production by the end of the decade?
Well, you see, in the factories where we are producing our cars, we are striving and we are achieving that we produce with green energy and that our manufacturing is on the path to CO2 reduction. That counts for our factories in Europe as well as in China and in the US. So this is definitely a general aim from the group Volvo, Geely, Polestar, which we are driving where we can drive it.
Let me ask you about your product. You are a car designer by training, Thomas, and you've done an incredible job. Just as a purely, my opinion, my editorial take, the Polestar 1 and 2 are beautiful vehicles. I'm a little bit confused about your identity. I grew up knowing about Polestar as kind of the performance end of Volvo's products, and now you're more the EV end of the products. In fact, your Polestar 2 is priced less than the XC40 at Volvo, their all-electric car. What does Polestar want to be?
Polestar is an electric premium car company. The Polestar 2 is our entry model. We will have, of course, more premium, more upmarket models coming. Yes, we were born as a racing company, indeed. We did a big shift, moving the company to become an electric car producer. The spirit of a company that is kind of improving, from race to race, week after week, not in this kind of big cycles that an OEM is working. I think that spirit of a racing company is still the spirit of the Polestar EV company.
Thomas, how complicated has it been for you this year, especially as competition heats up with other countries and companies recognizing this shift to the electric model, to get them the materials that you need to make the vehicles, not only with respect to the pricing, but also with respect to the labor?
Especially in supply chain, logistics, it's all for the whole industry a thing to tackle and to be really acting much differently to how we did it in the last decade. Yes, we have to be now much quicker and do everything on much shorter side. But it's a learning of the last year that we are able to adapt and to really quickly react and become much quicker in our reactions. I think that is what the whole, not only the car industry, had to adapt to in the last year, and we learned a big part, and it will continue in 22 and probably in 23 as well, that things are not happening the way that it happened before. All of that it's a new era, and we have to learn how to work with it. But it's not impossible. Of course, you have to adapt.
5 years from now, who do you think your biggest competitor will be? Will it be the Tesla behemoth that is the electric vehicle dominant player now, or will it be Ford? Will it be General Electric, or will it be someone else?
Yeah, it's definitely a very interesting mix of competitors in the EV market. Yes, like Tesla, obviously, but definitely our aim is to find customers coming from the big OEMs, premium brands that produce today still the majority of combustion engines, and really convincing those customers to try the EV and cover how joyful and how luxurious and premium it is to drive such an EV, and really get BMW, Mercedes, Audi customers into our cars.
Okay, Thomas, thanks so much for joining us. The Polestar CEO, Thomas Ingenlath, also getting ready, of course, for the listing of that business via a SPAC. We look forward to speaking to them around that time, perhaps. Now, coming up on the program, we'll focus on China. Freya Bremisch, TS Lombard, head of macro research, joins us. What clues are we getting about where the inflation story goes next in China? How slow is the growth in China? We'll talk to her about that. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards, live in London, along with Matt Miller and Lisa Abramowitz over in New York. Let's get to our next conversation, and this is around the inflation story globally. Inflation in the United States, but also inflation in China. We got the PPI numbers coming through from China this morning, eye-watering by some descriptions, over 13% coming through at the factory gate. And how is that passed on to consumers? That's an interesting one for us to think about globally, because sometimes that has a global impact. Let's go to our next guest, and as we do that, I want to take us there using this chart. Here, for our radio listeners, I'll just describe, we've got a chart that shows coal futures and steel futures in China. The coal futures really spiking up and then coming down again. Steel futures also showing a move to the upside and coming down again. And Freya Bremisch, head of macro research at TS Lombard, joins us. And the reason I wanted to speak about this chart, Freya, in our conversation with you is I just wonder whether we are set for slightly less eye-watering inflation numbers if we look at what we're seeing here on these charts around coal, around steel, around some of the inputs that have pushed inflation higher for Chinese businesses.
Yeah, I think we've had two legs of PPI inflation. So at the beginning of the year, I forecast that it would peak above 10%. Of course, there was a lot of uncertainty, so I didn't quite get to 13%. But there were two legs to that. The first was the response to the growth of Chinese M1 and the growth of demand in the rest of the world that really kind of pulled up prices against supply that was constrained. And the second was the chart that you've just showed. So that's much more of a purely kind of cost push type of inflation. And the reason why I think that it ends up being the kind of the last leg of this eye-watering uptrend is because there's no kind of further catalyst for this to continue within China, short of there being, you know, further supply disruptions, and of course that causes a lot of volatility. But on the demand side, there is what we see as a complete sea change particularly in the demand for credit. And the capacity of the Chinese economy to respond to the easing which we expect coming through from the PBOC. So the PBOC has started very early in its tightening cycle in May of last year as the recovery was beginning. And they were been very hawkish since then. They eased off through this year in terms of they're no longer were tightening, and they've only just shifted towards being a little bit marginally on the easier side. Probably they get to November, December, and they are more overt on that easing because the economy is so weak. But going into next year, I think is when markets and when you know, the real economy, the signals on the real economy will start to come through that money and credit is just not responding to that easing, and that is a sea change for inflation. It buys time for central banks in developed markets to more on their domestic position as well.
Freya, I know you're an economist by training at LSE, and you studied at Edinburgh Economy and Law, but you also lived in China, you speak Mandarin, you've got a handle on the culture as well. David Rubenstein at the Super Return Conference was just telling us that he thinks in some cases the U.S.-China relationship may be even worse now under President Biden than it was under President Trump. What do you make of that assessment?
Our outlook on the kind of the tariff side of it, which ultimately is the kind of the immediate thing which impacts the economy, is that things could get a little bit easier around the end of the year, and that China will be looking for ways in which to ease beyond monetary policy and fiscal policy, and even COVID policy, because they're so constrained there. So maybe that helps a little bit. But broadly speaking, yeah, once that Pandora's box was opened by Trump, and it was something that had been building up for a very long time, in some cases for good reason. You know, you can't just go around stealing intellectual property, and you can't just go around you know, relying on the rest of the world to generate demand as they were before, as China was before the global financial crisis. And it's a long period over which these tensions have been building up. And politically in Washington, I think that it has passed the point of no return. Within China as well, in a broader sense, they'll be looking abroad for kind of things to blame for the slowdown within China as well.
Yeah, Freya, how slow do you see the Chinese economy becoming here? A lot of focus on the zero tolerance of COVID, which for some people is limiting the ability of the economy. We've talked about some of the cost pressures around basic resources. How concerned are you around a slowdown in the Chinese economy? I've read a bit of analysis actually comparing China now to Japan in the 1980s. Ouch. It would take a thesis to compare the two really fully. But what kind of expectations do you have of the slowing?
So at the moment, we're seeing very weak growth. So quarter on quarter was basically nothing in Q3 on our numbers and on the official numbers. That's the situation. You probably get a bit of rebound in Q4, and Q1 is probably very weak as well, because they still have zero COVID tolerance. Probably the Winter Olympics is the turnaround for that point, as long as they get the boosters. That's all very short term. What really interests me is, as I said, the signals we get from money and credit. Is that responding halfway through next year? Because that would be the lag that we would expect. And if that doesn't respond, then we are looking at a very different China. So there's so much focus on what is full year growth going to be next year. That doesn't really speak to any of the longer term story, because we would only be expecting that failure of money and credit aggregate to respond to feed through into the real economy by the very end of next year. So we're slightly below consensus at 4.7% for full year growth next year. But what I'm really interested in is beyond then. And I think the comparison with Japan is in some senses is reasonable, because there is this massive debt overhang, and that kind of balance sheet recession, if you like to call it that way, is what China is now facing. I also think Korea is a good example in their crisis in 2003, when they had a household debt crisis, a consumer debt crisis, but household debt has continued to rise since then. So that's the kind of the difference between the Korean and the Japanese precedent. You get slightly higher growth in the Korean precedent.
Okay, Freya, thanks so much for joining us. Freya Beamish, head of macro research at TS Lombard, talking to us about the Chinese data and the Chinese growth story. The Bloomberg opinion piece by Richard Cookson on that comparison, China with Japan, really interesting and worth a read. Coming up later today, an exclusive conversation with San Francisco Fed President Mary Daly. That is at 11 a.m. in New York, 4 p.m. in London. This is Bloomberg.
Its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. And Tom Keene joins us now, co-anchor of Bloomberg Surveillance. Tom, what are you focused on today?
I'm focused on a gallon of gas you spent in Berlin. What was it, Matt Miller?
$7 a gallon, and that makes gasoline here seem pretty cheap relatively.
Yeah, you just fill up the Hummer. That would be outrageous. That would be like, weeks paying all that. Let's look at the American gallon price, and it's real simple. I don't have the chart here, Matt, but we can talk it through very simply. Francisco Blanche at Bank of America is modeling $120 Brent off of where we are now at 84.85. If you take the regular American gallon of gas, that gets you from $3.42 out to somewhere in the vicinity of $4.10 to $4.20 a gallon. And critically, Matt, that's the national price, which is not the San Francisco price. It gets San Francisco nicely out over $5 a gallon.
And that adds, good morning to you, Tom. I suppose that emphasizes why there's so much conversation about whether the United States is going to tap strategic petroleum reserves. Some of the data, though, yesterday in the markets didn't leave that impression, Tom.
Yeah, there's some history to this, and the answer is it's overemphasized. I got to be very careful here, Anna, because a lot of it is just research and guessing forward and that. But it is certainly understood to not be a cure-all for what's going on right now with really significant demand. And as many say, including Blanche, they say supply rigidities. The strategic reserve doesn't fix those two microeconomic realities.
All right, Tom, thanks very much for that look at what, to me is an incredibly important issue. Paul Sweeney is always complaining about spending $60 to fill up the Beamer, and I spend like 2 or 3 times that to fill up my big truck.
Well, and I've got 145 pence a litre to throw into the mix, and I can't do the translation, so I'll leave that to you.
All of those pence per litre, wow. All right, let's take a look at what else we're watching. Speaking of inflation, I'm focused in on CPI data. We're going to see today if it climbs even higher year over year. This is the September number. You can see the year over year number on your left there, 5.4%. We're looking for 5.9% today, and I will point out that economists were spot on with the PPI forecast yesterday. That came in at 8.9%. So we're talking about big gains that don't look, well, I wouldn't say they don't look transitory, because I think people misunderstand what transitory means. It's not a measure of something over time. It's a state of things. But it doesn't look like inflation is going to go away anytime soon, and it's certainly higher than the Fed wants it to be.
And the numbers can still be eye-watering and then be transitory, I suppose, can't they, Matt? So we'll see how high this number goes. A lot of people globally concerned around inflation, and increasingly in Germany, where you were for a long time, of course, Germany's Council of Economic Advisors urging the ECB, urging the ECB, described as Merkel's advisors, urging the ECB to set out a path out of the ultra-loose, expansive monetary policy that we've seen. And of course, we know that Jens Biden is leaving, and so maybe this hawkish voice just being thrown into the mix. Markets and central banks globally don't all seem to be on the same page about how to treat inflation pressures. Now, more Bloomberg surveillance is up ahead, of course. We'll be speaking with Margie Patel of Wells Fargo Asset Management. That conversation still to come. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
there's something bigger going on in the bond market than just the inflation story.
There is a good alternative right now, and that alternative is still equities.
Investors don't seem to care. They're hooked on the IV of very low real interest rates.
Investors are really tired of throwing good money after bad money.
The Fed is your friend during this period.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Inflation Day in America from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your longest winning streak of the year is over. Equity futures are down again. We're down 11 and off by 0.25%. TK, the CPI data, 2 hours and 30 minutes away.
CPI, actually a big deal. Michael McKee out in San Francisco with Mary Daly, and he'll give us perspective as well. John, we opened this hour with George Saravellos. You and Lisa spoke to him on Monday. Zero Hedge wrote up that research yesterday, and I'm sorry, Saravellos is right. We are bedazzled right now with what to focus on to get to 2022. I look at the spread market. It's telling me something. I don't know what.
Real yields lower, all-time lows on various parts of the curve. Tom, let's focus on one thing right now. Inflation data in America. The estimate, the median is 5.9. But look at JP Morgan, Morgan Stanley, Citi. They're looking for a 6 handle a little bit later this morning. Can you imagine, Tom, the sticker shock of a 6 handle on CPI in America?
That's a nice way to put it, a sticker shock, and the sticker shock is not transitory. That's a word, John, you may have remembered from the
T word. I'm familiar.
Past, is well. But I'm going to link in what we see in the markets to this huge mystery about the level and movement of inflation. That's what I'll be looking for at 8:30.
Lisa, how to process the incoming data has been a big task for this bond market over the last several weeks.
Especially because it doesn't have a clear answer to whether or not it's transitory. And it also is highly challenged as to whether wages can rise in tandem with consumer prices. I do want to point out, we've been focusing a lot on oil, but John, these are broader based inflationary pressures. And I think that will be the most interesting thing to see in the CPI report that comes out soon.
Is the point you're trying to make it's getting broader, not narrower, that perhaps it's more persistent and less transitory?
I'm just saying it's broader. This is something that Jim Bullard pointed to, St. Louis Fed president. Yes, I mean, this is the idea, is that it's harder to fix something that is multifaceted and coming from many parts of the economy than a one-issue button.
Who says they can fix it? I don't see that in the history books.
It's not just fixed, though. And this, to me, is the issue. It's how quickly can it abate due to supply-demand pressures that are concentrated versus a sea change in an economy.
This is the most contentious debate in global economics right now. We're going to have it through the morning on this program. Equity futures down 12 on the S&P. We're negative just a little bit. We're down about 0.25%. No drama here. Elsewhere outside of the equity market, your bond market yields are higher, 4 or 5 basis points higher on 10s, so 148.13. But that's the nominal yield. Tom, you keep bringing up the real yield. The real yield is deeply negative further out the curve.
There's a big debate on this, John, and I know you're going to garner that on Friday afternoon if we go to a record level, is, well, this is the nominal yield minus whatever you believe inflation is, and that is the residual or inflation-adjusted yield. What's critical here, John, is there's two moving parts.
Lisa, you mentioned crude. We're down about 0.6% on WTI, 83.67.
Yeah, we didn't get that announcement yesterday that a lot of people were expecting of the U.S. releasing some of the strategic petroleum reserves. Key question of what the trigger will be, and also the idea of potentially supply overwhelming demand a bit more than people had expected based on the U.S.'s own projections come next year. Highly contentious, highly uncertain. As we've been talking about all morning, 8:30 a.m., the big number of the day, U.S. October Consumer Price Index expected to rise at 5.9% year-over-year inflation. That would be the fastest pace of consumer price rising going back to 1990. Key question in my mind is how this dovetails into the labor market. And because we are getting a data dump today rather than tomorrow, which is, of course, a holiday in the United States, 8:30 a.m. also, we will be getting U.S. initial jobless claims. I find this fascinating. A post-pandemic low expected in the people filing for benefits for not having a job. But if you take a look at real wages, we're still seeing negative real wages, basically on an inflation-adjusted basis, still below where we saw going back all the way beyond 2013. How do we dovetail these two into a growth picture, or lack thereof, going forward? And today, President Biden is trying to sell his bipartisan infrastructure plan. He's off in Baltimore. He'll also be talking about how this could potentially affect longer-term supply chain disruptions. John, this doesn't address necessarily the shorter-term issues, which clearly are on President Biden's mind, considering the fact that he called the CEOs of several major companies yesterday to say, what can I do to keep the shelves stocked ahead of the holidays so that people can get their presents? It seems like that is an increasingly political issue.
The politics of the moment. Lisa, before you go, I've been excited to get your reaction to the Rivian IPO. $11.9 billion IPO, biggest of the year so far, $76 billion valuation on that company.
Throwing money at hope. That, to me, is what it seems like, because it does seem like electric vehicles are the future. But why will this company have any kind of upper hand to Ford, to General Motors, let alone Tesla, in getting supplies, in getting manufacturing, and then being able to sell it at a competitive price, let alone distribution channels, John?
We can talk about this through the morning. Tom, here's a company that only just started delivering vehicles a couple of months ago. Delivering vehicles a couple of months ago, and it has a $76 billion valuation.
John, you see all sorts of stupidities out there. Somebody had one of these like SPAC deals, which was, you know, in jest and frankly not appropriate, I don't think, for family TV like this. But it is a silly season. Every silly season is different, but they're all the same at the same time, where it is this strange word, speculation. They're not investments.
Are you willing to call this silly then? They've got massive backers, Tom. Amazon, Ford in the mix as well. Are you willing to call this one silly?
Yeah, Enron had massive backers too. Or, you know, WorldCom down in the deep south a million years ago. I don't want to cast aspersion on this, John.
I think you just did that, Tom.
No, I just think it's a silly season. Someone was out yesterday with a classic tulip bubble analysis. I don't want to go there. What I want to say is we're going to chronicle the story. And, John, you go to the heart of the matter, which is you put a $70x billion price tag, or value, I should say, on, as Lisa correctly says, hope.
Do you think it's part of a broader issue? That's the debate I want to have this morning. Just because you think you found a casino, Tom, does it mean we're in Las Vegas? I think that's the conversation we've got to have about this broader market.
Some of our viewers and listeners, including our first guest, aren't in a casino. They're like worried about, what am I going to do when I'm a fossil? I mean, I'm years away from that, John, but, you know, I'm sorry. Speculation is not investment, and that's what we're talking about here.
Margie Patel joins us now, Senior Portfolio Manager at Allspring Global Investments. Margie, can we just start with inflation in America? The range of estimates is actually pretty wide. At the top end, 6%. At the low end, 5.4. We're looking for something in and around 5.9. Margie, what are you looking for at 8:30 Eastern Time?
Well, we think something in that range is probably appropriate. And we do think that we will see inflation tapering down as we go through next year. We don't think the Fed's too off base in being a little optimistic about inflation going down, simply because it bites into real wages, and that's going to limit the amount of inflation we can have.
At what point, Margie, do you readjust the feeling that perhaps the inflation that we're seeing is something more persistent and will be the new reality going forward, affecting yields and, frankly, affecting big tech valuations?
I'm not sure how that can happen. That's what classically you would think. But I think that when you have the Fed has been very successful in keeping interest rates very near zero, 1 to 2%, I think they'll continue on that course, and that's just going to distort the price of all other goods and services. So I don't think it's going to affect high tech at all, because I think people are still going to look at the growth rate, the margins in those companies, and interest rates is really going to be a sidebar issue for a lot of investors, unfortunately, because it's almost become an uninvestable class.
Margie, if I am investing with, Allspring, retirement, long-term investment, how do I protect myself from timeless speculation? You know it's there. John just mentioned it. How do you protect yourself or buttress yourself, strengthen yourself against the damages of speculation?
Well, I think you look for real companies that have a history of going concern and profitability, and not buy into something very new and exciting, because those are often where you have that speculative bubble, like the SPAC bubble, which has fizzled out. Now you have the electric car bubble, which is percolating along.
Margie, since we're throwing around the word bubble, do you think there might be a bubble right now in inflation protection?
I don't really look at inflation protection because I've never found that an effective way to make money. I've either, been long parts of the bond market or I've gone over to the equity market rather than looking at those. I think that the measure of inflation really hasn't been very accurate. So again, I take that with a grain of salt and look at real companies.
Margie, thank you. Always good to catch up. Margie Patel there of Allspring Global Investments on this inflation day. Provocative question from me, Lisa, but after all, the demand, the hunger, the appetite for tips has been absolutely phenomenal through this year.
Well, and this is part of the reason why a lot of bond strategists say, look, we don't understand why yields are this negative on a real basis, but really it comes down to everyone trying to hedge in the same way, creating this distortion in markets. And I do think it's a valid question. Is this an accurate reflection of what longer-term inflation really is, or are we looking at a distortion? And that really is the main story.
That's a market question. I think for economics right now, the bigger risk going into next year, I think it's the biggest risk for anyone that deeply cares, Tom, about the labour market. There is a chance that at the start of next year, you get unemployment dropping towards a 3 handle. If we've got a 3 handle on unemployment and we've got inflation that remains persistent around current levels, Tom, how patient will policymakers be about doing the hard work to get the participation rate up? Will they throw in the towel on that effort very early and perhaps in the minds of some people, Tom, prematurely?
I think
that's a risk around the labour market going into Q1 for policymakers.
I think it is too complex to look out with an attempted crystal ball. John, what I would focus on is if we get 4, 5, 6% inflation, which we haven't seen literally in decades, what does that mean for corporations, American finance? What does it mean for all the things that our listeners and viewers deal with every day?
I don't think that's crystal ball type stuff, Tom. I think that's wargaming something out. I'm setting up a scenario here that could happen, could develop. You could have inflation with a 5 handle, unemployment down at 3, and a Federal Reserve preaching patience. And I just wonder, Lisa, will they be able to maintain that if that's the story when we begin a new year?
One of the key elements that I'm looking at, rents. If rents keep going up at the pace that they have, that will make it very difficult for the Federal Reserve to keep their stance.
The CPI data coming up a little bit later this morning, 8:30 Eastern time. That is your main event, 2 hours and 20 minutes away. In your equity market, we're down 10, soft and negative down by 0.2%. In the bond market, yields higher by 4 or 5 basis points to 148.13. On Bloomberg TV and radio, this is Bloomberg Surveillance.
With the first word news, I'm Rishka Gupta. Google has lost its appeal of a $2.8 billion antitrust fine in Europe. The EU General Court issued its ruling today. Google is accused of thwarting smaller shopping search services. The case is the first of 3 EU court fights in a campaign to rein in Silicon Valley. Electric vehicle maker Rivian has raised about $11.9 billion in the year's biggest IPO. The listing is the 6th largest of all time. Rivian is backed by companies such as Ford and Amazon. It's valued at about $76 billion. Bloomberg's learned that President Biden and China's Xi Jinping will hold a virtual summit next week. No specific date has been set. Ties between the world's 2 largest economies have quietly improved in recent months. Still, the US and China have sparred over Taiwan, and Washington is concerned about Beijing's expanding nuclear arsenal. And the UK won't join an alliance of countries fixing a date to phase out oil and gas production. The group is being spearheaded by Denmark and Costa Rica. It's expected to announce as many as 10 to 15 new members today at the climate talks in Glasgow. But the UK says it isn't joining because ending fossil fuel production could cause a cliff edge in energy supply. Elon Musk is the biggest loser. The world's richest person has lost $50 billion this week after Tesla shares plunged for the 2nd day in a row. It's the biggest 2-day decline in the history of the Bloomberg Billionaires Index. Musk still tops the list, though, with a fortune of $288 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Do you enjoy being a senator with all this pressure on you? Is this fun, or is it not that much fun?
My dad always said, if you can say no with a tear in your eye, you might be okay. And I've been crying a lot lately.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at. You'd have to look at what was you're defining as strategic or critical.
I was just finishing what you were saying, Tom.
Thank
November
you.
3rd
You did
when the
good.
decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This legislation is going to change the lives of every American. And we got the job done. By the way, we got some help from some Republicans who had the courage to vote for it initially and vote for it in the House. And now we need to do it again with my Build Back Better plan. And I'm confident we're going to get it done.
The President of the United States on the next big effort. From New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro on Inflation Day in America. Here's the data for you. Going into the data print itself, 8:30 Eastern Time. Equity futures at 618. We're down by 12 points and negative 0.25% on the S&P 500. Into the bond market, yields are higher by 4 basis points. PPI out of the factory gate in China. China PPI. 26-year high, 148 on 10s again, 147.96 to be precise. CPI in America just around the corner. In the FX market, euro weaker, dollar stronger, euro dollar negative here 1/3 of 1% to 115.57. And just to round it up for you, Tom, nicely with crude, 83.76, down about 0.5 of 1%.
Crude on the edge, 85 on Brent crude, I noticed as well. John, I do want to take a moment to say EM is exceptionally fragile. Turkey revisits some real angst this morning. And John, there it was on my terminal. It's just one statistic in the blinking red and green and amber. Argentinian peso, 100 to the dollar. Reuters has the black market quoted out near 200 pesos per dollar.
There's an ugly round number, Tom.
Yeah.
26-year high on China PPI. How does that bleed out to the rest of the world?
Well, exactly. This is really, really important. The bleed out here, it's not endogenous. It's not just within China. It is extended out as well, including at Washington. Emily Wilkins briefs this morning with Bloomberg Government. Emily, I want to get right to the timeline here. We need to revisit and recalibrate the timeline to a Biden FDR-like program. What is that timeline right now?
So the big holdup right now, the legislation, that social welfare and tax bill, it's in the House. And you hear from a lot of Democrats there that they are supportive of the bill. They want to vote for it. But a small number of moderate and centrist Democrats have said, hold up, we need to get the Congressional Budget Office to tell us how much this bill is going to spend, how much it's going to raise. Now, the Congressional Budget Office, it's going to take a couple weeks to calculate that. Remember, lawmakers are not in D.C. this week. They'll be coming back next week. And they're hoping that week, the week of November November 15th, the House will be able to vote on the bill, send it to the Senate. Senate makes changes, send it to the House. The hope is that this can wrap up before the end of the year.
Give us an idea on the recalculation, the scope and scale you see. A couple of weeks ago, maybe 2 months ago, we had some recalc that was $1 trillion larger, whatever the number was, I don't remember as well. On the given statistic right now, is CBO just barely looking at it, or are they looking at a possible real jump in total cost?
I mean, that is a big question right now. I mean, when we saw the House initially take up this bill, even though there were discussions about bringing it down to below $2 trillion, currently at $1.75 trillion, there were a number of programs in there that were going to cost a little bit more than that. So there's a large question mark about exactly what the Congressional Budget Office is going to be finding here. Remember, though, we did see some scores earlier last week showing that the bill would be able to raise well beyond the $1.75 trillion needed. That was from the taxes as well as provisions related to drug pricing. And so there is a chance that these numbers can come out and House Democrats could say this looks good to go, but that's not necessarily a guarantee of what we're going to see next week.
Emily, this bill might have some influence over remedying some of the longer-term supply chain issues. Short-term, though, heading into the holidays, very much an issue for President Biden, certainly with his calls to the heads of major companies. How much can the U.S. government actually do at this moment to ease some of the supply chain constraints versus just try to message that things will get better into the holidays as it becomes a campaign issue?
Lisa, that is such a major question right now for the Biden administration. I mean, you've seen President Biden try to address this via messaging, going to LA. Today, he'll be in the port of Baltimore, really emphasizing both that infrastructure bill passage as well as what the White House is trying to do to make sure that some of these supply chain blockages don't wind up disrupting Christmas, that they can figure out ways to sort of ease a little bit of the inflation, looking at different things when it comes to oil and gas prices. But you're right. I mean, these are global issues here caused in part by the COVID-19 problem. And there's really only so much that President Biden's going to be able to do. That makes it even more critical that he really be able to focus and to message on that infrastructure bill that was just passed, because that is a clear example of Democrats being able to actually get something done and focus on the issues here in the U.S.
Well, a little more than 2 hours, we're going to get the CPI print, consumer prices, how quickly they're going up. How much does this actually go against passing any additional stimulus, any additional spending? Because a lot of people said this has been fueled by all of the spending earlier this year and last year.
Well, Democrats, to a certain extent, don't necessarily agree with that analysis. What they see is they look at 2022. They look at the midterms and they look on delivering promises that they feel that they made to voters in the past election. Things such as expanding health care, helping with child care, with elder care, addressing climate change. So for Democrats, they're looking at a much wider playing field than simply inflation. They are aware that it's an issue, but they're also hoping that some of this does resolve itself as the market continues to get past the pandemic, and that they're hoping that there will be in a better place at this time next year when elections are rolling around.
Emily, just quickly, a 6% handle is possible, a 6 handle on inflation at 8:30 Eastern Time. Can you help us understand what the messaging will sound like from both sides down in D.C. if that's the data point we get?
Well, you can expect Democrats probably to pivot to continue talking about the infrastructure bill, what they're trying to do. But you can absolutely expect Republicans to hit Democrats very, very hard on this issue. And to a certain extent, you know, Republicans are reflecting a lot of concerns out there with Americans as they're seeing these prices go up. Republicans understand that there is a lot of frustration out there among the average working class American, and they're really making sure to tap into that as we are seeing these reports showing that inflation is continuing